Our agenda is somewhat changed. The President Pro Tem is here, and due to his schedule, we are going to have our informational hearing first, and then we will consider the 4 bills that are on our bill agenda. We are beginning as a subcommittee. Senator Padilla was here. Senator Alquist is at Health Committee and will join us shortly, and Senator Ashburn will be here. Senator Walters is absent. So first, I'd just like to welcome everyone. We're going to talk about the Democratic budget proposal, the proposed tax reform package that is a part of it. And please keep in mind that we're not here to discuss the entire proposal, nor the entire budget, but the part that is, I believe, creative and intriguing, that decreases the sales tax and increases personal income taxes and vehicle license fees. Most of the other parts of the tax package have been considered by the Budget Conference Committee and the relevant subcommittees. Given our difficult budget situation, the need for reform in our tax system was identified by the governor and the recent Commission on the 21st Century Economy. Now is the time for new ideas. That is a certainty. We've had hearings on this subject with many of the folks who will be here later. And today we have Senator Steinberg. You've offered a bold reform plan. And we'll hear about that today, of course, from you. And from others, from the LAO, from the FTB, from the BOE, and from experts in academia and business, and then any others who wish to comment. So, Senator Steinberg, let's proceed.
Thank you very much, Senator Wolk, Madam Chair, and members of the committee, staff, and members of the public. Senator Wolk, I appreciate your invitation to me to discuss the tax reform proposal included in the unified Senate and Assembly Democratic budget plan that was adopted by the Budget Conference Committee last week. We are advancing this proposal as a way to generate revenue for the budget through intelligent tax reform that exports the state's tax burden to the federal government to the extent that is practical and to the extent that is practical. The tax reform proposal represents a key piece of the so-called budget architecture to close a $19.1 billion deficit and provide a stable and growing source of general fund revenues in the years ahead. Ongoing revenue, not one-time revenue. The proposal itself is actually fairly simple. You can't say that about too many issues relating to the tax code, either in California or the country, but it really is simple. It raises state taxes that are deductible on federal income taxes, the personal income tax and the vehicle license fee. It lowers substantially a state tax that is not deductible, the sales tax, and it limits the net revenue increase from the tax swap to the increase in federal deductibility and the state tax cut, resulting in lower taxes paid across all income levels in California. It may be true, I will admit, Madam Chair, that there are no new ideas under the sun here in California. The press has reported accurately that former legislators advanced this concept of swapping federally deductible for non-deductible taxes at different times over the past 20 years. Given all of the interest in tax reform and the magnitude of our budget difficulties, maybe the time for action is now. Certainly, the academic literature on state taxation has questioned why more states don't attempt to maximize the federal deductibility of their tax structures. This idea may claim many fathers, but it was brought to my attention as actually a Republican idea, as a way to potentially gain the needed revenue to avoid even deeper cuts in essential state services while providing a net tax break to taxpayers. Of course, it has now morphed a little bit as July moved on, and now it is a proposal fully embraced by both the Senate and Assembly Democrats, and we hope that we might bring the governor and the Republicans back to the table to either agree with the proposal or to tell us where they believe it is flawed, to suggest changes, amendments, different modeling, or maybe a different tax reform proposal altogether. But this is the only credible idea that is out now for public discussion. The proposal is intended to be bipartisan, that could advance many of the policy objectives articulated by the Commission on the 21st Century Economy, otherwise known as the Parsky Commission. That commission, as you may recall, did yeoman's work in my view. They worked very, very hard. But their proposals, frankly, fell flat with its proposal for a new business net tax receipt, otherwise known as BNRT. Nonetheless, the Commission offered a thoughtful critique of the state's present tax structure. For example, the Parsky Commission suggested that the state consider flattening the PIT, personal income tax, marginal tax rate structure by raising the rates on lower and moderate income taxpayers relative to high income taxpayers. Reduced progressivity in the PIT would have two beneficial effects on general fund volatility. First, it would lessen the state's relative dependence on capital gains, business income, and other volatile income sources that flow to high-income taxpayers and are thus currently subject to higher-than-average tax rates. Parsky Commission, of course, pointed out that the top 1% of taxpayers in the year 2006 paid 48% of the personal income tax. The Parsky Commission also pointed out that a flatter PIT rate structure would smooth out revenue growth over business cycles. Now, this isn't, this kind of proposal I might point out in terms of who's willing to step out there a little bit and take some chances. This really isn't a traditional Democratic proposal to suggest reducing progressivity in any way. But we recognize if we're going to hit that proverbial sweet spot and attract any possibility of bipartisan support, that you got to give to get. And our get here is reducing the level of devastating cuts and investments in public education and other vital public services. The tax reform proposal before you would flatten the PIT rate structure by raising all the PIT rates by 1%, except for the top 9.3% rate. Additionally, the proposal would maintain the temporary 0.25 surcharge on all rates, including the top rate. So the top rate would remain higher than what it otherwise would be, but not as high an increase as the other rates. Even after those changes, I would point out, California's PIT would remain one of the most progressive personal income tax structures in the nation. Could you tell them I'm busy, please? Thank you. The Parsky Commission also recommended improving the deductibility of state taxes. In addition to the PIT changes I have mentioned, the tax reform proposal would raise the VLF permanently to 1.65. Both the PIT and the VLF would be fully deductible from federal taxes. And the 1.65 rate for the PIT would be lower than when the governor entered office, lower than the 2%. Parsky Commission also recognized that California's sales tax rate, the highest in the nation, is a burden to consumers and businesses, and recommended gradually eliminating the sales tax. The proposal before you would reduce the state sales tax from 6% in 2009-10 to 4.25% in 2010-11 and 3.5% by 2011-12, a nearly 50% decrease. Such a substantial cut, members, in the sales tax burden very likely will boost taxable sales, particularly for big-ticket items like appliances and automobiles. For example, under this proposal, state sales tax on a $20,000 automobile would fall from $1,200 to $850 in 10-11 and $700 in 11-12, a substantial incentive for California consumers to help the automobile industry and help the overall economy. Any increase in consumer sales will mean more jobs in the private sector and more sales tax revenue for the public sector. It's not only the retail sector. Lowering the sales tax rate will improve the competitiveness of California's manufacturers, since the sales and use tax is levied on the purchase of business inputs, which are incorporated into consumer products that are themselves taxed. Lowering the state sales tax rate will reduce the double taxation and function much like the manufacturer's investment tax credit, a mini-MIC, if you will. Finally, Madam Chair and members of the committee, the most important point, or at least an equally important point, lowering the sales tax will benefit the poorest Californians and those in the middle income ranges. At the lower level, many of whom do not pay any personal income tax, but all of whom pay a higher proportion of their income in sales tax than those with higher incomes. In evaluating this proposal, I encourage everyone, Democrats, Republicans, the governor, to be mindful that the conference committee adopted this proposal to help close the $19.1 billion budget deficit. The purpose of this proposal is not simply to cut taxes. That would be a fairly straightforward exercise, undoubtedly one that would attract a lot of support, but also one that would result, certainly in the short to medium term, in an even larger budget deficit. We have not seen a budget proposal from the administration, from the legislative Republicans, or anyone else for that matter, that could credibly balance this budget without some additional revenues. Many large cuts proposed by the administration simply would be held up in court, like his proposal to devastate the IHSS program. Other proposed cuts would require approval of the federal government that will not be forthcoming, such as his proposal to cut $1 billion from the Medi-Cal program. Excessive budget cuts would result in the state drawing down less revenue from the federal government that otherwise would be spent in the state and multiply throughout the economy. We are talking about billions of dollars from the federal government that are at risk in this budget. Excessive budget cuts would diminish the financial and administrative capability of state and local governments to administer contracts with private construction firms and other vendors, resulting in a loss of private sector employment. You know, don't take my word for it. I'm the leader of the Senate and the Democratic leader of the Senate. But I would commend the committee and anyone watching this hearing today to read a speech delivered by George W. Bush's appointee as chairman of the Federal Reserve Board, Ben Bernanke's speech in South Carolina just over a week ago. Mr. Bernanke warned in that speech that budget cuts, quote, are part of the reason for the sluggishness of the national recovery. He said that he did not think state budget deficits can be solved simply through across-the-board cuts in existing state programs. He went on to say that notwithstanding the very difficult near-term budget issues you face, speaking to most of the 50 states in the Union, I urge you not to take your eye off the important goal of promoting growth. Physical investments such as infrastructure development, adequate transportation networks, and the like are necessary for economic growth. But he didn't stop there. He said, but for sustained economic development, investment in people, in their knowledge and skills is even more important. Ben Bernanke. Members, a fair and honest resolution of the state budget deficit requires some new and ongoing revenue. This tax reform proposal allows us to realize new revenues in a way that will spur consumer sales and business investment, maintain public investments in education and other services that are keys to our long-term prosperity. And finally, I'll reiterate what I said earlier. The only other tax reform proposal that anybody has seen publicly was the well-intended hard work of the Parsky Commission. Universally criticized, not just by the stakeholders on the Democratic side of the aisle, but universally criticized as a non-starter by the business community. The governor has said tax reform is an essential piece of closing this year's budget and essential to the future health of California. It's not enough to just poke holes in the modeling here. Tell us how you would improve it. Tell us how you would improve it so that we can get on with the people's business, finish this state budget, and move on with the rest of the challenges we face here in the state of California. Thank you, Madam Chair.
Thank you, Mr. Pro Tem. There's an opportunity for questions if you like. Otherwise, I'll just move ahead with some questions I'd like to. Okay. Go ahead.
I think that the Pro Tem is to be commended for outlining a proposal related to the tax structure, especially the changes that under this plan would take place in the sales tax and then offset in a manner in the income tax as the beginning of a solid proposal for tax reform to make California's tax structure respond to the economic reality. And you mentioned this, Mr. Pro Tem, that 40% of the transactions are business-to-business transactions. And we do around here, and I've sponsored them, targeted tax credits to incentivize a particular business activity in the hopes, of course, of generating more economic activity, job creation, and the resultant tax revenues to support essential public services. But a broadly based change in our sales tax, substantially reducing it, would have an incredible sweeping effect in the business-to-business transactions. At the same time, we have an income tax structure that is, out of kilter. We have a huge part of our population with an income and no income tax obligation, in a manner of speaking, no buy-in to the governmental services that they receive as Californians. So this plan isn't the total answer, but this conversation today is an important step in advancing what I believe is correctly identified by the governor and the Pro Tem and acknowledged by the Republican leaders, the need for tax reform as part of the solution to establishing a more stable revenue foundation for the financing of government. And wouldn't it be amazing if we could use this year and this opportunity to make a big step forward? So this conversation, I hope, is viewed as a very constructive beginning.
Thank you very much, Senator Ashburn. Can I just, if I might, I appreciate your comments and you're willing to work on this. I also want to give some kudos here to another colleague on the panel here, Senator Wright, who, when the history of this success is written, we'll speak about a caucus some months ago where Senator Wright eloquently discussed many of the elements that are contained within this proposal and advocated that we take a different approach to tax reform. And like Senator Ashburn would say, this, whether this is 100% on the mark or not, it reflects a genuine effort at reform. I want to thank Senator Wright for helping suggest this in the first place.
I think a couple of things that are important. My district is not necessarily unique, but different in that I have very affluent and very poor people contained in the same district. When I discussed with the poor people the idea of paying more money in exchange for being able to keep the services that many of them have come to depend on, subsidized child care, for example, for a recently transitioned welfare mother is worth $1,200 or $1,500 a month. If we cut that, she can no longer afford to work and risk going back on cash aid or something else that would ultimately cost the system potentially more money or do harm to her children. In 1986, the federal government changed the law relative to the deductibility of sales tax. It was Rostenkowski from Chicago who later
Passed away today.
Oh, is that right?
Oh, my.
Yeah.
Oh, my.
Just on the news. Passed away.
You know, I got to quit talking about people.
He passed away before your time.
But yeah, the late Congressman Rostenkowski, who chaired Ways and Means for many years, but when they made that change, it altered the manner in which many of finances were tracked. And for people who don't remember, he also eliminated interest on other than real estate and limited the amount of interest that could be deducted off real estate to 2 pieces of property. And there was a cap on how much you could deduct from the 2, which became game-changing. Clearly, when we had a lot of capital gain revenue, I mean, everybody here, knows the story of the guy who was in a garage and then, 2 weeks later he was a billionaire or whatever it was. The difficulty with that is that we lived on that kind of capital gain revenue for a long time, and we moved the bar so that we were capturing a greater percentage of that in the general fund PIT allocation. That model for us is unsustainable. If it was a geometry problem, we now have an inverted pyramid. A pyramid where it stands on the point and there's not enough people at the bottom of that point to keep the pyramid balanced. By adding more people into the pool, you provide more stability to that pyramid so that you flatten that out so that you do 2 things. One, you don't leave yourself wholly subjected to the volatility of the people who do great capital gains. But the other thing that I think is important is that you eliminate some of the class warfare that we've had, where rich people say the poor people don't pay, and you make sure that the poor people have skin in the game. We were talking about a couple of things in that. I remember, and I'll shut up, talking to many of the manufacturers, some of whom have left my district, some of whom are leaving my district. One of the difficulties that California has is that we're one of but a few states that charges interest or sales tax on manufacturing equipment. Now, people will say that that's a giveaway, except if I'm in Napa and I buy a wine press, I'm clearly not going to drink all the wine that comes out of that press. I'm buying it so that I'm able to hire people to create wine that is later sold. When I had the conversation with the Toyota people at the NUMMI plant in Fremont, the gentleman explained to me, he said, if we wanted to make another car here, to build the line that it would take to manufacture that car would cost us $500 million. You, California, would charge me $50 million in sales tax, where Texas wouldn't charge me a dime. In addition to the other impediments that you have, you're making yourself competitively disadvantaged to attract the kind of business that we'd like to get. That was why I thought we had to do something about the manufacturer's tax. We have to be careful, Mr. Pro Tem and Madam Chair, that we don't initiate taxes that actually could result in a net loss in revenue. That's a potential. The federal government did that, you may recall, with the yacht tax. We created a tax on when people made yachts. It just forced people to buy the yacht from someplace else, and we ended up with no yacht business, and the Europeans simply captured all of that market. If you look at, Mr. Chair, even when we did the cigarette tax, if you look at the general fund revenue, we lost roughly 20% of the general fund revenue on cigarettes. Now, the Prop 5 people started at zero, so whatever they got was all net. But the general fund took a hit, not because people began smoking less. They just altered where they bought the cigarettes from. And I think we have to be careful that people don't perceive that because you increase the tax, that the public reaction will be static. People will adjust not only their buying habit, but where they get it to account for how you make that claim. So I'm sensitive to that. I represent a great deal of poor people, and when I began looking at the alternatives of what would be cut, adult day health care, and I know a lot of people will go, what is that? Well, imagine that there's a lady whose mother has Alzheimer's and diabetes, and she stays in the mother's home. She gets up and she's a bus driver for the MTA in Los Angeles. Before she can go to work, she unlocks the door to let her mother out. And you say, well, what do you mean? Because Mama might go cook Thanksgiving dinner in August if you don't lock her in the room at night. That wouldn't be good for you. Or she might just walk down the street to go see a friend and forget where she was. You have to get Mama to a place where she's going to get an insulin shot, her blood pressure checked, her sugar monitored, fed, and know that she's going to be secure when you get off work. We in California subsidize that, and it's a service that I think we should continue to provide. It would cost roughly $1,200 to $1,500 a month in addition to the Social Security that her mother may have earned. She couldn't afford to do that and drive the bus. So if we took that service away, we probably now have a double casualty, the bus driver and her mother, who end up having to suffer, just as the lady who gets subsidized child care. These are all services that at the end of the day provide something. And the other part with the cuts, and I'll shut up, I wouldn't. The governor's staff, when they were calculating the savings that we would pick up on returning the CalWorks money, in my district, the CalWorks money is much of the revenue that sustains the community. So I've got people who say live in a housing development, whether it be the Nicholson Gardens or Jordan Downs or some of the larger housing developments. Well, they don't pay much for rent, and they use food stamps to buy much of their food. They ain't got 401ks and 529s and their money is spent on a regular basis, and most of what they spend the money on is taxable. So the $4 to $6 billion that we would be returning in federal money is actually about 50%, give or take, money that was going to come into the general fund. So we might save $1.5 billion, give or take, in the state share of the CalWorks money, but we would give back roughly 2 to 3 in general fund revenue that would have been a portion of the CalWorks federal portion. Many of these programs, some of the health programs, have a higher match than the CalWorks do. So simply saying I'm going to give back the federal money and eliminate the program is dollar wise and pound foolish. And as we would say in South Central, if it don't make dollars, it don't make sense. So we've got to begin looking at how we maximize what we can do. And I don't want to see us get in a position again where we're pitting poor people against affluent people, where we're saying, it's their fault. Whether you be an immigrant from wherever you're from, or whether you be a poor welfare mother from Watts. I don't want us to pit the two against one another. The services that we provide, God forbid anybody in here would ever need to go to the Department of Rehabilitation. I've got one of those offices in Watts. You're in an automobile accident and you get your brains knocked out. And when the paramedics scoop your brains up and put them back in your head and they deliver you to an emergency room, by the time you heal, you realize that you've forgotten how to do some of the things that you took for granted. in the past. We have a department in California that actually allows people to get back to some level of service. I think that's a valuable service. Some would argue it's too expensive. We do that on a non-means tested basis. Some people pay some people don't pay anything at all. But if you've ever been to a Department of Rehabilitation center and seen people who started off unable to navigate at all, graduate to a wheelchair and then graduate to a cane and have some ability to perform a valuable function in society, the people who work at that Department of Rehab provide a service that's important. And I would hope that in all of our things that we don't lose sight of that and then castigate people because someone ran through a traffic sign and caused them to end up at the Department of Rehabilitation, or get mad at a lady because she had 2 kids, but now she's trying to work, so we yank her child care away from her. Or we say to a lady who's a bus driver, I'm sorry about your mama, but you're going to have to keep her at home. Because if you look at, again, in my poor part of my district, I'm seeing an increase in foster care placements as those mothers lose their jobs and they're unable to care for the kid, and their 60-month TANF grant has expired. So, yes, when I went to poor people from Watts to Compton and Willowbrook and other parts of the state and said, would you pay $30 or $40 more so that people could keep those services that we've come to depend on? They all said with a resounding, they absolutely would. And then when I talked to the rich people and said, if I got the poor people to put more in the game so that it wasn't all on your back, they said if they put some in, I'd put some in. I'd leave you with, clearly Bible and Luke speaks to whom much is given, much is required. That's a given. Everybody should put something in the plate and have some skin in the game. Whether you're a welfare mother in Watts or whether or not you have a palace in Rolling Hills Estates, everybody ought to have some skin in the game according to their ability to make it work. And it shouldn't be equal sacrifice, but it should be equal suffering. Everybody doesn't pay the same because everybody doesn't make the same. But I think if we have that as a fundamental element, that everybody knows that everybody ain't getting over on everybody else, that I think people will be much ready to go. And I didn't mean to take that much time, Madam Chair.
Thank you, Senator Wright. Eloquent as always. We do have a quorum. I need to take roll. Please call the roll.
Volk,
Here.
Ashburn,
Present.
Alquist,
Here.
Padilla.
Here.
We have a quorum. Thank you, Senator Wright. Darrell, I wanted to ask you some just general questions. You hit most of the points in your statement. When we did our hearings on the tax reform proposal, there were certain certain goals that they wanted to achieve that had to do with the sales tax and with volatility and improving deductibility of taxes, etc. And you've incorporated a number of those into the proposal, and I'd just like to learn a little, just examine those again individually. The one thing that happened with the COTSI report, as you said, is despite having set out some goals that were universally agreed to, the recommendation and the results seemed to go off in another completely different direction that nobody supported at all. This issue of the state sales tax, the state portion of the sales tax, do you want to expand a little bit about that and why? What difference does that make in terms of the health of the economy, frankly? Just basics.
First of all, the Parsky Commission, the Koski report, as it's sometimes referred to, did speak about the economic development advantages of lowering the sales tax. The reason for lowering the sales tax is multifold. Number one, there are few stronger business and job creation incentives and lowering the sales tax. And I think Senator Ashburn spoke to that just a few moments ago. Whether it's the manufacturing sector that, as I said and others have said, oftentimes get double taxed in terms of the inputs, or whether it is the retail sector, whether it's the automobile sector, we are looking for a spark to our economy. This would be a great spark for our economy. Look what we did in March of this year when we passed a sales tax exemption for green manufacturing equipment. This would only expand that notion in a much more significant way. The second issue that I stated earlier, in terms of the way this proposal would affect working people, lower income people, middle income people, even for those who do not deduct or itemize, on their federal income tax returns, or who don't pay personal income tax, they get a real break because the studies are very clear that the middle to low income people in general spend a higher percentage of their income on consumables than higher income folks. Now, some critics have said, well, that's not true of everybody within a particular income strata. 10 years here, I've never figured out how to legislate for every single individual circumstance. The best you can do, of course, is to take the credible studies and try to model for income levels. And so based upon the history, based upon the right kinds of averages, our proposal would be a net tax break across income levels.
The last estimate that I saw is that California receives from the federal government 80 cents for every dollar that we spend. What is the relationship between this and deductibility and getting the more money?
This is one of the great advantages of the proposal. I recall traveling back to Washington, D.C. with Governor Schwarzenegger and the other legislative leaders back in February, where the rallying cry led by the governor, and we were right there with him, was California deserves its fair share. And, I can't remember the number of times he and we stated very clearly that California exports more tax dollars than we import, and that's plain not fair. Well, we can change that, at least to some degree, on our own here, by being smarter about what we tax and what we don't tax. Why would we pass up an opportunity to increase our opportunity to bring more federal dollars into California? And that's what this does by virtue of increasing the PIT and the VLF, again, below 2% on the VLF, and dramatically lowering the sales tax.
Senator Alquist, I think you had some comments or questions.
I was chairing Senate Health, and I'm sure a lot of this was discussed. Just some points to make. Number one, I am very supportive of the plan. There's just one point that I'd like to be on record. But before I get to that, the positives are: wouldn't it be nice by July 1st, 2011, to have a sales tax that was 3.5%? Whether it came to buying computers, I represent Silicon Valley, or whether it's appliances or cars or what have you. I like that a lot. The one point that I'd like to be on record is that part of this, and I understand that no plan can be perfect because it's put together by human beings, but I sure know that you did your very best, and that I think it's really good. The one point I'd like to be on record on, though, is that one premise that this is based on is that for ages to come, the feds will give us that deductibility on personal income tax. And if by chance that goes away with higher personal income taxes, a lot of Californians would be paying a higher amount. So my only point to state here, because more than likely none of us would be here at this point in time, but I just wanted to say it for the record, is that should that occur, I hope this state legislature would be vigilant to come back and address the point about deductibility, so that really there at any point would not be we would not be really paying higher income taxes.
That's a great point. I don't anticipate that the Congress is going to change the law, but if they do, it would be our obligation to come back and refine a proposal like this in a way that met the same objectives we're seeking now.
Right. Thank you.
Thank you.
Senator Padilla, did you have any comments or questions? Okay. Darrell, what would be the total amount that this would bring in next year, the year after?
It begins $1.8 billion and grows over time by 2015-16 to $3.3 billion. It goes from 1.765 in 10-11 to over $2 billion in 11-12, 2.8 billion in 12-13, just over $3 billion in 13-14, and again 2 years later gets up to $3.33 billion. So it's and it's ongoing and it's significant. I mean, we always bemoan the fact here that, all you can ever do is kick the can down the road and do one-time solutions, and that we're all back here again the following year, and we pray for rain and economic recovery, and and it's not all
water comes up.
It's not all with yes, I know. Sorry, and it's not always within our exclusive control here. But here we have a chance to take some matters into our own hands, create that ongoing revenue stream, but do so in a way that is beneficial to the economy, to economic growth, and to California taxpayers.
Maybe you'd like to set that in some context of the kinds of cuts that we've had to go through for the last, certainly since I've been here, since 2003 and 4. I mean, the kinds of changes that have happened to the general fund and to California.
I mean, one of the problems, I might just say, with the budget process and the politics around the budget process around here, speak candidly, it's just us, right? It's just yeah. Okay.
Can we talk?
Yeah, to speak candidly, is that when we get into these debates, some folks, assume no history here. It's like we're starting from scratch. Well, I don't think that's the right way to look at it, because I know since you elected me to be your leader, that we together have cut over $32.5 billion of significant public investment. And nothing was immune, whether it was public education, higher education. Certainly, we whacked in a terrible way the employment services for those people who are currently on assistance trying to get back to work. We made other very deep cuts to California's safety net, and it's not as if I come here to say that in this circumstance that we refuse to cut. That's not the case. We have to. You cut, as I've said over the last week, you cut out of necessity because it's the responsible thing to do. But cutting itself is not a virtue. And here we have an opportunity to draw that appropriate line for the people of California and not cut any deeper than is necessary with intelligent, credible revenue ideas. It's not acceptable, in my view, for anyone to just dismiss it. Help us improve upon it, and let's get this done.
Well, this is, unless there are further questions, I know that the senator has a meeting with the governor coming up very quickly. So I would just like to close by saying, what we're going to be doing for the rest of the afternoon is we have several panels. You're welcome to stay as long as you like, if you can. And it will all be recorded. We have a panel, first of all, with the LAO and the Franchise Tax Board and BOE. And then we have a panel of academics. When your proposal came out, we shipped it everywhere that we could. And we've, in a very short period of time, we got a lot of responses. Most were positive. I'd say super majority were positive. Were very positive. And
I hope they're the ones we're going to hear from today.
But we have two, all very well respected, and we have two of the finest here with us who could make it. And then we have representatives from the business community for another panel, and then we're going to hear from the public and hear what folks think. But I'd just like to close with one comment that came from one of the academics, and that's Professor Dan Simmons of the Davis Law School, who's one of the tax professor, who said that he thought it was an extremely creative and good idea, and he thought you had a very good tax professor.
I sure did.
I'd like to congratulate on.
Thank you, Professor Bruce Wolk,
yeah.
class of 1984.
So,
details later, including my
anyway,
grade.
So this is the beginning. This is the beginning. Thank you, Doug.
Thank you very much, Liz. Thanks for all the preparation. And
sure.
I think the most important part is coming now, where we hear from experts on what this means, how we might improve it.
Okay. And
Thanks.
Steve Shea,
I'm sorry. I introduced Steve Shea, who, deserves a lot of credit here for working day and night during the month of July to help us refine and model this. Thank you, Steve.
Okay. Thank you, Doug.
Good.
All right. I'd like to invite up the first panel. Steve, if you want to join us wherever you'd like. Wherever you'd like.
I'll join you. I'll just stay here then.
No, stay there. All right. Can we have the LAO and the Franchise Tax Board and the BOE? You know, I keep inviting the Franchise Tax Board and the BOE just to hang out at the dais all the time. You're really welcome to do that. You don't have to hide in the back. All right. Well, welcome. LAO.
Jason Cisney with the Legislative Analyst's Office. I direct the State Finance section at the LAO, and I'm also here with Justin Grossi, who is one of our economists who leads our work on the personal income tax and on this proposal. I'll begin with an overview, then talk about some of the assumptions that's gone into our preliminary analysis that we're going to present to you today, and provide some conclusions. In our view, the general concept of modifying the state tax system to increase the federal deductibility of state taxes has merit. In essence, it means the potential of bringing in more federal dollars to the California economy that could help offset the effects of tax increases that you may have to put in place to balance the state budget. What strikes us as difficult about this proposal or any proposal is figuring out a way to meet the stated goal of holding each income group in the state neutral or seeing a net reduction in taxes. Our analysis concludes that the conference proposal does increase combined state and federal taxes for some groups, and it will be very difficult for you to put together a proposal that meets the goal of achieving as much revenue impact as you want for the state, while at the same time holding each income group harmless, if you will, when looking at state and federal tax liabilities together. That being said, there are definitely modifications that you could make to this type of proposal that would move you further in that direction. Since the release of the proposal, there has been discussions about the estimates of the total size of the increased federal deductions that would occur and the distributional effects of the plan on various income groups in California. These questions are very difficult to answer, and reasonable minds can differ on the assumptions that go into this analysis. And the estimating assumptions are really key to the outcomes that are produced. So different people can come up with different assumptions for how to gauge the effect of this proposal on the overall economy and on each income group. We built our own preliminary models. They are preliminary. They rely on somewhat different assumptions and methodologies than that in the conference estimates as well as the Department of Finance estimates, and I'll run you briefly through some of the differences. First, with regard to federal tax policy. Changes in federal tax policy, one way or the other, will affect how this proposal affects each income group in California. Under current federal law, federal income tax rates are scheduled to increase in 2011 to their pre-2001 levels. President Obama has proposed that the lower tax rates be extended for taxpayers earning below $250,000. And so right there, it is unclear what federal tax rates will be in place for the coming years. Unlike some of the estimates that you've seen, we are going to assume in our models, in our base models, the adoption of the President's proposal to allow higher rates to return for upper incomes. Second, there is the alternative minimum tax. As you may know, the federal alternative minimum tax currently affects about 75% of California taxpayers earning more than $200,000, and with a smaller effect on other taxpayers. It is difficult to model this issue precisely, but it has an important effect on the distributional impact of this proposal. Given our assumption that the President's proposal to let the upper income rate cuts expire will be approved, we assume in our model that only about 30% of California taxpayers earning over $200,000 will be subject to the federal AMT. Higher regular tax rates generally reduce the number of AMT taxpayers. The assumption of this is important because, for the most part, AMT taxpayers would receive no benefit from increasing federal itemized deductions. State and local taxes are generally not a part of the picture for AMT taxpayers. An important issue is also figuring out how many tax filers would choose to itemize. About 62% of California taxpayers currently do not itemize on their federal returns. And for those who continue not to itemize, there would be no federal tax benefit from the higher state income taxes and the VLF that are included in the proposal. The issue is what percentage of current non-itemizers would begin to itemize. In our model, we assume a modest increase in this number. And there are also issues with regard to the treatment of taxes paid by businesses. A portion of the taxes are initially paid by businesses. In our model, building upon some work completed last year by the Tax Commission, we allocate most tax paid initially by businesses to the various income groups. Using this assumption, we looked at the effect of the proposal on the California economy in 2011-12. It's more difficult to do that for 2010-11 and less representative of the long-term picture because in 2010-11 tax rates are higher than their ongoing levels due to your budget agreement from last February. So we felt it was most appropriate to compare the proposed changes to the ongoing levels which would be in effect under current state law beginning in 2011-12. Our estimates indicate that in 2011-12, the proposed personal income tax and VLF rate increases would raise more than $10 billion in state general fund tax revenues. This gain would be offset by a drop in sales tax revenues of over $7 billion. And there would be a net benefit to the general fund under our estimates in 2011-12 of $3.1 billion under the proposal. So while state taxpayers would pay $3.1 billion more to the state general fund in 2011-12, we estimate, their tax liabilities owed to the federal government would decline for those taxpayers who itemize and are not subject to the federal alternative minimum tax. We estimate that the increase in federal deductions across all California taxpayers would reduce federal liabilities by about $1.5 billion. And this is a much lower amount than assumed in the conference documents and somewhat smaller than the Department of Finance's as well. So to summarize, we think that in 2011-12 it would increase state tax revenues by $3.1 billion and result in reduced federal liabilities of $1.5 billion, and that means that taxpayers' combined state and federal taxes would be higher by about $1.6 billion under our model. Some of these taxes would be paid by non-residents. So in looking at the effects by income group, we tried our best to focus on the effect on state residents. Our model shows that across all income groups, state residents would pay a net increase in federal and state taxes of about $1.2 billion. Several income groups would pay higher taxes, obviously, because there is an overall increase in state and federal tax payments. Specifically, we found that every income group that we looked at between $20,000 and $200,000 would see a net increase in state and federal tax payments. And throughout the rest of the income distributions, most of the rest would see a decrease in state and federal tax payments. But there would be an increase in state and federal tax payments for each income group between $20,000 and $200,000. The estimated effects of the plan on each of these income groups will vary markedly based on different assumptions that you use about federal tax rates, about the incidence of sales tax and vehicle license fee, and a number of other factors. So like any other analysis that you get on the economy and the budget, the assumptions that go in drive heavily the assumptions that go out, and we would stress reasonable people can differ on these assumptions. I think to conclude, we would point out, again, that we think that this general concept has merit, increasing the federal deductibility of the state tax system. We think that by modifying this proposal, you could come closer to achieving the goal of having more individuals, more income groups have a net reduction in state and federal taxes. Those changes might make it more difficult to raise the state revenue that you want to raise. For example, one of the ways that you could achieve that change would be to take a further reduction in the state sales tax, and by doing that, you would bring more taxpayers into a net reduction situation. The consequence of that, however, might be less revenue raising for the state's general fund. And so I'll leave that and take your questions whenever you like.
All right, I think we'll go through the entire panel and then ask questions of all three of you. Are you going to be putting together a written summary of what you just gave us?
We can communicate to you and give you some of the key tables and some written background. We'll be happy to do that. Apologies for not having it ready, but we literally were just finishing it in the last day or two.
That's true.
Yeah.
The decision to hold this hearing was fairly recent, and so I appreciate sending that information to us. All right, let's hear from the BOE. Welcome.
And thank you. Good afternoon, Madam Chair and members. I'm Robert Ingenito from the Board of Equalization's Research and Statistics section. A lot of the mechanics of the sales and use tax portion of the plan have been covered by previous speakers, so I'll just hit them very briefly. Under the plan, the general fund rate would drop from the current law amount of 6% down to 4.25% in 2010-11, and then a further decline to 3.5% in 2011-12. We've done some calculations, and we currently estimate that the statewide, state, and local average tax rate right now is 9.10%. That's, as Senator Steinberg mentioned, the highest in the country. If this plan were implemented, we estimate that the ranking would drop to about 9th or 10th, assuming other states don't change their tax policies. We've done some scoring of the sales and use tax component only. We've seen literature from the plan's release, which indicates about an $8.5 billion loss in sales and use tax in 2010-11. We come up with a similar number. The one thing we would point out, though, is that's a full-year impact. And we, the board, are going to require some lead time to implement any rate change that you direct us to implement. And I'll get to more of that at the end of my prepared remarks. At this point, given some material has already been covered by other speakers, the most helpful material I can present to the committee would be in the area of the BOE's administrative costs. One thing to alert you to is that the proposal would impact the split in who pays for our sales and use tax collection and enforcement admin costs. Right now, we collect the sales and use tax not only just for the general fund and for the state entities, but also for local governments. And both the state and the local entities share in the collection of those costs. And under the plan, because you're cutting the state sales and use tax rate, proportionally, the local jurisdictions would be accounting for more of the combined rate. As a consequence, local governments would be picking up more of our fixed collection costs. Our collection costs wouldn't change because the tax rate doesn't change our costs. Other things such as the number of taxpayers and enforcement activities drive our costs. But reducing the sales and tax rate at the state level would, again, proportionally indicate that the locals would be paying more of the tax, so their collection costs would increase and the state's general fund share would decline. Okay. The amount of that shift depends on when the rate change would be implemented and other factors that are we're not able to lock down yet, but as a rough magnitude, we're estimating that about a $30 million general fund shift to local governments is what would take place in 2010-11 if it were a full year Again, it's going to be less than that given that we can't implement for the full year at this point. That number we estimate would increase to about $59 million in 2011-12. And then the final thing just to bring to your attention sort of is some of the administrative things we have to do in advance of a rate change, either up or down. Changes to the sales and use tax rate have impacts to both the taxpayers we serve and the board's staff itself. For taxpayers, a rate change requires such things as cash register and computer programming changes, modifications to price sheets, price lists, bid sheets, menus, invoices, contracts, and all the other things businesses need with which to conduct business, in addition to employee training. For the board, we have two main challenges. Number one, anytime there's a rate change, the board prepares and distributes a special notice of the rate change to affected retailers, including both those inside California and those outside as well. Many retailers rely on official word from the Board of Equalization before they begin the process of implementing a rate change. So it's imperative that we have enough lead time so that we can notify retailers in a timely manner. The second impact from a rate change is an internal one to the board itself, and that is that we need to revise the sales and use tax returns that we prepare for use by the taxpayers. We need to make related programming changes to our internal computer systems. Most sales and use tax revenue is reported to the board on a quarterly basis, and here the timing is key. From the board's perspective, administration costs and concerns are reduced if a rate change takes place on the first day of a calendar quarter. So in the current environment, October 1st, 2010 would be our preferred date of a rate change. As the days go by, assuming the budget deliberations continue without resolution, if we get into late August and early September, then the October 1st date gets called into jeopardy. And the date would slide. Our preferred date would slide, making sure that we get the timely option to notify retailers like we require. Okay, so with that, those are the main two administrative concerns I wanted to bring to the committee's attention, and with that, I'd be happy to answer questions when the opportunity.
I will ask you a question about the lead time for retailers and those changes. First, let's finish with the FTB. Welcome.
Thank you. Madam Chair and committee members, I'm Jay Chamberlain, Director of Research at the California Franchise Tax Board. I've been asked to speak to a couple of issues regarding the budget tax reform package. As a reminder, the Franchise Tax Board administers the personal income tax and the corporate tax, so I'm going to be focusing on those issues with the exception because we have data on with the California income tax returns, we get data on federal returns. We have federal income tax data, and we have a general expertise in income taxes. I'm also going to be speaking to how changes in the sales taxes and the vehicle license fees affect the calculation of the federal income tax. So the first issue that I've been asked to talk to is the federal deduction features of this proposal, and I think that's been generally covered. I'll go through a couple points. So taxpayers are generally allowed to claim itemized deductions on their federal returns for items such as mortgage interest payments, property tax payments, and other items, including state and local income taxes and vehicle license fees. This is where the deductibility aspects of the proposal come into play. Since the proposal would increase income taxes, vehicle license fees, while cutting sales taxes, it would tend to increase deductibility, as other speakers have mentioned. There is, I will point out that there has been at the federal level, a temporary allowance of taxpayers to elect to deduct sales taxes in lieu of income taxes. That election is, under current law, expires in 2009. However, it has been expired, so it's one of those things like so much in federal law. We're not sure what even 2010 law is going to hold, let alone 2011. But in any case, most taxpayers who do itemize on their federal return will prefer to use the income tax deduction as opposed to the sales tax deduction. Even under current law, obviously with this proposal, it becomes even more so. Californians who pay the federal income tax are allowed to take the greater of the standard deduction and their itemized deductions. And so this gets into the question of whether taxpayers are going to get any benefit from the additional income tax and vehicle license fee. In 2009, the standard deduction was $11,400 for a joint return, $5,700 for a single return. In addition, taxpayers who own a home and pay property tax get an additional $1,000 for joint returns and $500. So the threshold that has to be overcome in order to itemize is you need, for a joint return, you need $12,400 of itemized deductions and $6,200 for a standard deduction. In summary on this point, the potential benefit to California taxpayers from the increase in PIT and vehicle license fees depends on whether they itemize and what the marginal federal tax rate is. Additionally, as Mr. Cisney has pointed out, also it depends on whether they are in an AMT position, it is somewhat of a it's an unknown right now exactly what those federal provisions will be and what federal tax rates will be, what the and so how deductible these items will be in subsequent years. The other item, or second item I was asked to talk to was the tax increase proposals, or how this proposal would increase personal income taxes. Essentially, as has been stated, it would raise tax rates in 2010 by 1% for every bracket except for the top bracket. And then in 2011, it would raise the rates by 1.25% relative to current law, and for every bracket except for the top bracket, which the rate would increase by only 0.25%. How will this affect different taxpayers? Well, the tax impact on taxpayers depends on a lot of things. However, if you look at the 2010 effects, there will be, because the top rate, or the rate for the top bracket, is not adjusted, the maximum tax increase will be about $468 for a single taxpayer, and for a joint return, it would be about $935. So once you get into the 9.3% bracket, or the 955 bracket, you would be paying the maximum amount. So whether you're and for 2010. That's about, for a single filer, that's about $47,000 of taxable income, and $94,000 of taxable income for joint filers. Once you hit $94,000, you're paying the maximum tax increase for a joint filer of $935. If you make $1 million, you're still paying the additional $935. If you're making less than that $94,000, your tax increase is going to be somewhat less than that $935. For 2011, the calculation isn't quite so simple because there is an increase in the top bracket. But once taxable income reaches that top bracket, again, about $94,000 for joint and $47,000 for single, and that's in taxable income, which is the income after deductions are taken into account. Once you've reached that bracket, for a single filer will be paying about $600 more. A joint filer will be paying about $1,200 more. And then as your income increases beyond those top bracket thresholds, you'll be paying about you'll be paying $2.50 for every $1,000 over the threshold that your income increases. So just to give you a few examples, how this would impact taxpayers via the PIT tax. For a California family of 4 with adjusted gross income of $40,000, taking the standard deduction of $7,390 in 2010, they would pay an additional tax of $167. In 2011, that same taxpayer would pay an additional tax of $209 under this proposal. A California family of 4 with adjusted gross income of $80,000 and deductions of $25,000 would pay an additional tax of $544 in 2010, and in 2011, the same taxpayer would pay an additional tax of $684. Finally, a single taxpayer with AGI of $60,000 and deductions of $19,000 would pay about $400 more in 2010 and $516 more in 2011. Finally, the revenue impact. We just focused on the PIT rate increase. We estimate that the impact of this proposal. We estimate it using the department's microsimulation model. We then took the increase in liability for each year and then considered how that money would come in through estimated payments, through withholding, and through return payments. We estimate that in 2010-11, the PIT rate increase would bring in about $8.7 billion. In 11-12, bring in about $6.8 billion, and then in the 12-13 fiscal year, about $7.6 billion. So that concludes my comments. I will be happy to take questions.
Thank you very much. Are there questions from the committee? All right. I just want to pursue a couple things. Mr. Ingenito, I wanted to ask you again about, you talked about the administrative issues, the cost of collection that would suddenly be different between the locals and the state, and the local proportion would probably increase then.
That's right.
Okay.
The amount would not change, but the shares would.
But the share would increase. Correct. You mentioned the retailers and the mechanisms for making that rate change, but you didn't talk that lead time is necessary. But how much lead time do you think on their parts is necessary to make these kinds of changes to the sales tax rate?
Well, I guess there's two issues to consider here. One is the sort of minimum amount of time we actually need to execute the change to make it work at all. Mm-hmm. We've supplied information to the budget committees of both houses that in the current environment we would need notification of a rate change enactment by the end of this month to make October 1st feasible.
October 1st. Okay.
Our preference is, like I said before, the first day of a calendar quarter. The reason for that is because our filers generally file on a quarterly basis. If you were to make a start date of the rate change to be, say, November 1st or December 1st, our filers would have to file so-called split returns, part of it with one rate change, part of it with another rate change. That's what increases our administrative issues and costs, and that's what we seek to avoid by trying to get the first day of a calendar quarter to be the implementation date.
Okay, I understand that. That is, but I was interested from the retailer perspective, the mm-hmm. people who have to make the changes to the
yes.
cash registers. That could all be done at the same time. I mean, they don't need. If we were to make a decision about this by the end of August, put this into effect beginning October 1st, then the retailers are. The state may be ready to go, but mm-hmm. we assume they are as well.
That's correct.
Okay, all right. Thank you for that. All right. Well, I don't have any further questions. Panelists, anything? All right. I want to thank all of you for your information. Don't go far. All right. Our second panel, we will have two tax professors, Professor Joe Bankman, who is the Parsons Professor of Law and Business at Stanford Law School, and Professor Kirk Stark, who is the Vice Dean, Professor of Law at the University of California, Los Angeles Law School. Welcome to both of you.
Thank you.
Good to see you.
You're welcome.
All right. So, Professor Bankman, you start.
Okay.
What do you think?
Well, I like the proposal. For years, tax policy wonks have suggested that states have deductible instead of non-deductible tax. It's kind of a no-brainer, and yet states don't do it. So here we have a proposal that reduces a non-deductible tax, effectively the sales tax, and increases the deductible tax, the income tax. It's a smart proposal that brings in billions at little or no cost to California. So when you actually can find something for nothing, it's probably a good idea to take it. And I support the proposal for that reason. I just want to make 4 small points about the proposal that might be useful. First of all, I want to note that while the sales tax is generally an efficient tax, California sales tax isn't an efficient tax. It isn't an efficient tax. One of the reasons it's for exactly what Senator Ashburn said and served as a basis of a bill by Senator Alquist last year. We're taxing business inputs. That's just stupid. So we're reducing the reliance on that.
Not our bill.
Yes.
Not our bill.
That's right.
No, excuse me. You knew what I meant, even though it didn't what you say. The current practice of a sales tax is kind of silly. We oughtn't to do that. Just makes us less wealthy as a state. And I note that I think Senator Wright and Senator Steinberg also said that. The other thing we do is we overtax manufacturers relative to service providers. That's really stupid, too, and I might mention that later on. Second of all, this bill avoids increasing taxes at the margins. That's a little controversial because it's tempting to get the tax at the top, let's be honest. But the top and the margins are very important in terms of savings behavior in particular, so this bill avoids placing the tax at the top of our marginal rates. Third of all, I want to assent to something Senator Steinberg said, and I noticed one of you at least kind of nodded in sympathy with, is that I think it'd be a big mistake to judge this bill by slicing and dicing each marginal group. First of all, it's impossible to find anything that's going to benefit everyone. Second of all, in theory, it's not even good because it ignores the expenditure side of things. So you get, to paraphrase what Senator Wright said, maybe this bill is more friendly on the tax side to the wealthy than the poor. On the other hand, maybe the expenditures are more friendly in the other direction. And so what you really want to do, and you have to do, is tie that all together, and be a big mistake to reject otherwise good ideas on their own simply because every idea has to be straitjacketed so it's good for everyone. My final point is that as long as you're looking at changes in the tax mix that might make this state more productive, there are other changes you can consider. And, of course, Senator Wilk had some of us testify earlier in connection with the Parsky Committee, and Kirk and I threw some of those changes out. I'll mention them just for a second again and then answer questions you might have. One change I already mentioned is that we'd be wealthier if we equalize the burden between manufacturers and service providers. Right now, one pays tax on sales tax, the other doesn't. A second point is that we're taxing things now that we really want to encourage. An income tax, for example, unavoidably at the margin could discourage, for example, savings or work effort. We can debate how much it does, but all of us who look at it say it's going to. Why not start taxing things we want to discourage? The one thing I mentioned last time was the use of gasoline. A lot of it goes to commuting. You'd be better off having a higher gas tax, which hasn't been indexed for inflation in I don't know how many years, and reducing some other taxes that would be lead to more productive economic activity. Other changes you might make is we've got a huge cash economy out there. It's effectively tax subsidized because the rates of collection on taxes you already levy are pretty low. And so that's another way, for example, our manufacturers are overtaxed as they're competing with sectors that aren't paying their tax. Now, of course, when you think about what it would entail to stop this, you'd actually have to give the FDB more resources. It would mean more audits. I'm not saying it's politically popular, but in terms of being more productive as a society in 20 years, that would start pushing us in the right direction. Well, those are some of the ideas for you to consider, and I'd be happy to take questions after my colleague across the miles, but co-author, speaks.
Professor Stark.
Great.
Thank you, Professor Bank.
Thank you very much. In 2003, I published an op-ed in the Los Angeles Times titled "Smart Tax Laws Would Leave More Money in California's Pockets." And I should say that even then, 7 years ago, this was not a new or particularly original idea. This is something that's been floating around, as Senator Steinberg said earlier, for decades. Of course, the point of that piece was to highlight the value of structuring the state's tax system so as to take better advantage of the deductibility of state and local local taxes under Section 164 of the Internal Revenue Code. And at the time, I was kind of specifically associating myself, I guess, with the views of Governor Schwarzenegger, who was, I believe, calling himself at the time the collectinator. And I thought this might be a nice way to go about implementing that idea of being a collectinator and sort of reducing the balance of payments deficit that is sometimes cited with regard to Californians' payments to the federal government. So, not surprisingly, I was pleased to see this proposal, which explicitly aims to take advantage of federal subsidies that are available for state and local taxes. I just want to focus my comments briefly on some of the promise and potential pitfalls of this proposal. And most of what I'm going to say has already been said either in the first two panels or by my colleague Joe Bankman here. Again, it's as you know, this rule for the deductibility of state and local taxes comes from Section 164 of Title 26 of the federal law. There are three structural features that were highlighted specifically in the previous panel that I'd like to mention once again that are very important in thinking through the benefit of this plan to the state of California. Number one is that this is, of course, an itemized deduction, the deduction for state and local taxes, and thus it's available exclusively to those taxpayers who file a Schedule A with their federal income tax return. Number two, the state and local taxes are not deductible for purposes of the alternative minimum tax. This is something that chiefly affects taxpayers with income AGI in excess of $200,000 a year, but I'll say a little bit more about that. The AMT, of course, has been around for decades now. It's not indexed for inflation, and as a result, it's become a more and more important feature of our federal tax system. And then number three, for those who can claim the deduction, that is itemizers who are not subject to the AMT, the value of the deduction, of course, is a function of the taxpayer's marginal tax rate. So deducting $1,000 is not the same to somebody who's subject to a marginal tax rate of 25%. For them, that deduction would generate a benefit of $250. Then for somebody who's subject to a marginal tax rate of 35%, for them the value of that $1,000 deduction is $350. So the higher your marginal tax rate, the greater the value of an equivalent amount of deduction. So these are all well-known and obvious features of the federal deduction for state and local taxes, and I'm glad you had the previous panel because I think it's very important to get a handle on the exact data regarding federal income tax returns filed by Californians in order to take maximum advantage of these rules. In just sort of sorting through the most recent data from the IRS Statistics of Income Division on their website yesterday, I pulled out a few things that I thought might be useful to just for discussion purposes to get a handle on how this plan might be crafted or modified so as to take better advantage of some of the benefits. And I'll focus here first on itemizers. So for out of all of the federal income tax returns, individual income tax returns filed by Californians for the tax year 2007, and those were returns that were due in the first instance on April 15th, 2008. That's the most recent year for which data are available. There were 17.6 million returns, individual income tax returns filed by Californians with the IRS, and 37% of those were returns that included a Schedule A. That is, returns where taxpayers were itemizing deductions. So that obviously leaves 63% of taxpayers who are non-itemizers. Here it's important then to kind of slice and dice by income level. The IRS data do this only in kind of 5 different categories of income, but it's worth noting that 76% of those taxpayers with AGI over $50,000 itemize their deductions. So primarily non-itemizing is a phenomenon of taxpayers with AGI less than $50,000. So you can kind of think of it as $50,000 being the break point. Those with AGI below that number generally do not itemize, and those with AGI above $50,000 generally do itemize, with 76%, rough, whatever, 3/4, right? The other point I want to make is about the alternative minimum tax. Here, 4.2% of all of the returns filed in 2007 were subject to the AMT. So this is 741,000 returns out of the 17.6 million, so 4.2%. And again, as I mentioned earlier, the AMT is chiefly a phenomenon for those who have income in excess of $200,000. One thing that has not been mentioned, one of the very few things that I'm going to say that has not already been mentioned, is that it's worth noting that there's some substantial number of taxpayers, high-income taxpayers, that blow through the AMT. This is true, I'm guessing, I haven't looked at his income tax return, but I'm guessing it's true for the governor, for example. Taxpayers who have a substantial portion of their income taxed at the highest federal marginal tax rate, which is currently 35%, are more likely to be subject not to the AMT but to the regular income tax, because the top rate for the alternative minimum tax is 28%, and the top rate for the ordinary regular income tax is 35%. So the more income you have, and this probably, I don't know what a good cutoff would be, but I would say probably for taxpayers who make more than $1 million, you're getting into a range where you probably have blown through the AMT. And so you're back into a range where the deduction for state and local taxes at the margins is providing a benefit to you, and also a benefit at the highest possible federal marginal rate. Finally, those with income between those two ranges, so that in the $50,000 and lower range, they don't benefit generally because they're non-itemizers. In the $200,000 and higher range, with this caveat about blowing through the AMT, generally won't benefit by virtue of the AMT. But in that kind of middle category of between $50,000 and $200,000, 73% of taxpayers itemize, and only 4% are subject to the AMT. So that's the sort of population of taxpayers who are most likely to benefit from a swap out of a non-deductible tax into a deductible tax, assuming you could somehow make it so that their state tax liability was otherwise held constant. They would benefit by virtue of having available to them a deductible tax rather than a non-deductible tax. Now, again, this is a point that's already been made, but I think it really bears emphasizing what we here in California cannot control. We cannot control the characteristics of the households that are filing tax returns that might influence whether or not they itemize, and also whether or not they're subject to the AMT. So those are things that are just completely out of our control, and at that point you just kind of have to say, well, you do the best you can. For example, most people become itemizers when they purchase a house, and they have a mortgage interest that they're paying that is deductible as a Schedule A itemized deduction. And so that's something that's going to happen or not in somebody's life at a particular age, at particular economic circumstances, that probably is going to be a more important determinant for them as to whether or not they itemize, rather than tinkering with their state tax liability at the margin. So the other thing that you can't control, of course, is federal law. It was noted earlier, and I think this is certainly true, the federal government at any point could repeal the deduction for state and local taxes. They could also eliminate the alternative minimum tax. They could repeal the AMT. More likely, and I think the LAO's assumptions here are spot on as usual. They may let some of the 2001-2003 tax cuts expire, but not all of them. The chief result of that I think is something that needs to be paid attention to is the reintroduction of the two top brackets of 36% and 39.6%. That has two very important effects. If that change actually takes place, this change that's being advanced in the Obama administration's budget proposals for 2011, if that change takes place, that means that many taxpayers in that $200,000 and above category are no longer going to be subject to the AMT. Why? Because their regular income tax liability is going to be increasing, and since the rule is you pay the higher of the two, obviously increased regular income tax rates is going to lead more people to be off the AMT. It also has the effect of juicing up the value of the deduction. So, again, a deduction at 39.6% is more valuable than a deduction at 35%. So, these are factors that are worth taking into consideration. But I would say that, on balance, given all these uncertainties, probably the best that the state can do is to just generally shift the tax system. This is a shift that I very strongly endorse in favor of what we might call potentially deductible taxes for purposes of the federal income tax. And here I'd just like to draw your attention to a February 2008 paper from the Congressional Budget Office that had the exciting title, The Deductibility of State and Local Taxes. Table 2 of that document shows that California, it's a listing of all 50 states in the District of Columbia. California, as a share of own source revenues, the CBO was noting that California had a 21.4% of all of those revenues came from potentially deductible taxes. And that puts California pretty much in the middle of the pack, some 20-something in the rankings. In terms of the percentage of all own source revenues that come from potentially deductible taxes. And what I think this plan does, which I strongly support, is it gives California the opportunity to really climb in those rankings. And I think that's something that we really ought to do. It's money on the table, as Joe said and as Senator Steinberg said. It's a very good plan. It's not perfect. It can't be perfect because of all of the things that we can't control. But what it is it's smart and it's focused and it's incremental. And these are, I think, very good characteristics of any sort of tax reform proposal. Two other minor things that just occurred to me as I was sitting here in the audience that might be worth thinking about in connection with this proposal. First, I think we need to be also smart in thinking about, and I know that folks here in Sacramento are very attuned to this, how spending cuts also have the effect of reducing federal aid to California. So this is obviously true with regard to both Medi-Cal, where we get Medicaid money from the federal government through the FMAP matching grant, and also through CalWORKS, where we're getting federal money through the TANF matching grant. So if we're thinking about cutting programs that give rise to a federal match, that's another balance of payments type cost of a cuts-only approach that needs to be factored into the equation. The other thing I would say is that we need to also keep in mind the fact that over since the Obama administration took office, and if their budget proposals go forward as planned, we are moving structurally in the direction at the federal level toward a tax system with greater progressivity. That is, the tax burden is going up for high-income folks, and it's generally going down for low- and middle-income folks. And from my personal perspective, that gives California a little more space to adopt smart focused and incremental reforms that might, in a different environment, might be criticized for being regressive changes. But given the changes at the federal level, I think we have some space here at the state level to consider reforms that might otherwise be criticized as regressive.
Great.
Thank you.
Okay. Well, thank you, both of you. I have some questions, but let me defer to the committee. No? Nope. Okay. All right. I wanted to first go to Professor Stark. I want to go back to the itemizing issue. Is there any way, you said that only between the 50 and the 200,000, there are only about 73% that itemize, that are eligible to itemize, or that itemize?
That itemize.
Okay. So the others are eligible to itemize.
Well, anybody's eligible to itemize, but the only reason you would itemize is if you have deductions in an amount sufficient to exceed the standard deduction.
Is it possible that there are people who simply don't know about itemization and their benefits? I mean, I don't know. Financial
It's certainly possible.
literacy being what it is.
Yeah. I think that's certainly a possibility. I mean, I think the other point that a gentleman made earlier in the second panel, that once you augment the state tax liability of some current non-itemizers, they will become itemizers as a result of this proposed change. So again, this is just a kind of an obvious point of these are not static figures, of course. The question is, do your itemized deductions in the aggregate exceed the value of the standard deduction? And this plan makes it more likely that current non-itemizers will in future years have deductions that exceed the value of the standard deduction.
I want to ask you about what's going on in other states, whether most states are facing incredible budget deficits because of what's happened over the past 2 years. But are there other states who have done something similar to this, for which we can draw some kind of conclusion from which? Either reducing the sales tax, the overall sales tax dramatically, or changing the personal income tax? Or not?
Yeah, well, certainly there's a lot going on in all states. There aren't really any sort of blockbuster examples that jump to mind of states that have blazed a new path with innovative tax policy. They're all subject to the same sort of fiscal constraints and political parameters that we are here as well.
But they don't have a 2/3 vote. I mean, that's significant.
Fair enough, yes.
So in terms of tax reform, are others looking at different approaches than this one?
Well, there's certainly a great deal of heterogeneity out there in the country. For example, some of the states that have the highest percentage of potentially deductible taxes, as reported by the CBO, are states without an income tax. Florida and Washington, for example, these states that, and this is only as a result of the temporary change that was alluded to earlier that's in current law that allows for the deduction of general retail sales taxes in lieu of income taxes. So that's one thing that those states have done successfully, at least during the Bush administration, was that they were able to successfully lobby for a change in federal law that modified the federal subsidy in a manner to their benefit.
Both of you were here earlier in the year to talk about the COTC report, and I'd like you to contrast Senator Steinberg's proposal, or compare it to that one.
Well, gee, that's an interesting question. I'll just take up time till Kirk comes up with a really good response. How's that?
That's a good question.
The COTC report was kind of surprised everybody because it came up with kind of a new animal, which
Joe, I think I'm ready.
You know, it doesn't take a long time for Kirk. It's that mind that's always working. The new animal had a lot of problems with it, and it was a real big unknown. This isn't really much of an unknown. The previous panel there correctly said we don't know exactly how many people itemize, and we can debate exactly what the numbers are, but there's really we're not taking the risks here. That is, this is getting some deductibility. Now, the Parsky report also had a thought that they might kind of increase the ambit of the state taxes, and that's kind of a separate issue that we're not discussing here. So it's kind of an innovative idea. Whether that would have worked to get more of, say, Amazon's income in the state is questionable. So they were going off in a whole other direction. I'll say this much for them: it was more innovative in the sense that people had never thought of the kind of solutions they came up with. This, in an odd way, is innovative in the sense that states haven't done it. That is, basically, states haven't gotten rid of their sales taxes for the income taxes. I mean, I think the short answer is no. People haven't done it. It's been around forever, and states, on the whole, haven't done it. Whether or not they'll start to do it now, we don't know. I don't see any of that happening, actually. So I think this is a kind of riskless way to get some benefit. It doesn't resolve fundamental problems with our tax structure. It's really a kind of a one-trick pony, but it could bring in billions a year, I would say.
Okay. Professor Stark?
I agree with Joe. I mean, I think that's the chief difference, is that this is more incremental. Whereas the Parsky Commission's proposals were, let's start from scratch, or at least start from scratch with regard to those things that can be changed without amending the Constitution, and see what we can come up with. And that's a useful intellectual exercise, although I think what the experience with that commission showed is that that's an incredibly difficult and also treacherous undertaking because of all of the legal, political, and economic uncertainties surrounding any change. Now, there are some of those uncertainties with regard to this plan, but this plan is, interesting, smart, and focused. Not nearly as ambitious, but its ambition is a smart ambition.
I appreciate your comments, Professor Stark. When you were here last time, you also used those words to describe reform as smart, focused, and incremental. And I think that's for our state that would be a step forward. So I want to thank both of you. Don't go far.
Thank you.
Thank you. I'd like to invite the next I'm sorry, Elaine, did you?
No,
didn't think so? All right.
They were extremely informative, as always.
Thank you.
Our next panel is Mr. Bill Dombrowski. Come on down. President and Chief Executive Officer of the Retailers Association, and Peter Welch, President of the California New Car Dealers Association. Welcome. Bill, you want to start?
Thank you, Madam Chair.
Welcome.
We were just asked to comment briefly about the effect of the sales tax component of the proposal. And while there's no data that I could find over the last week that specifically addresses this kind of thing, there's a number of incidents where we've had sales tax reductions of a significant amount across the country. And they're done through the sales tax holidays that certain states have adopted. With a reduction of this size, I think you can make some of the safe assumptions that you'll see some of the same consumer behavior. There was a study done on Florida in 2009, and the results of their sales tax holiday. Just to start with the obvious, it's extremely popular. And the reduction in the overall price the shopper pays because of the sales tax reduction increases the sales, obviously, of merchandise. The other thing that happens that you might not think about is that retailers take advantage of the reduction, even though a permanent reduction like this, and try to work in other kind of promotions so that you take advantage of the traffic coming into the store and obviously sell more goods. A fourth point that we would like to point out is that you see this shift, and Peter can probably talk to this better than I, where you have counties with different sales tax levels. And you'll see shifts in buying patterns because customers go to where the lowest sales tax is. In California's case, right now, one of the things we have is a fairness issue going on with the Internet. And obviously, lowering the sales tax rate comes at a perverse way through the fairness issue. But it does bring, in fact, reduce the advantage that Amazon has over bricks and mortar retailers. And this is a major point with us.
That's true.
The fifth point I would make is that it's pretty consistent that the benefits are passed through to the customer. I mean, it's worked that way in Illinois, Florida, New York, wherever. And it's also pretty consistent that the benefits, though, are a little uneven in how they're who gets them, and that's just because who shops. So you think about it, you've got middle-class consumers, families, females, Hispanics disproportionately benefit from a sales tax reduction. So overall, while we don't have a position on the overall package, we do have obviously desire and support for a sales tax, and encourage the state to look at the sales tax in this situation and in the budget situation.
Okay, thank you. Mr. Welch, welcome.
Thank you, Madam Chair and members. I did have a handout here.
Sure.
Maybe we could pass those around. Hopefully there's enough of them. Well, I know there's enough of them. Again, I'm Peter Welch, the president of the New Car Dealers Association, and I'm going to make reference to the handout as we go through, but I'd just like to basically start and say we are the largest single sales tax generator in the state. On any given year, we're 12%, and one of the charts I have in here will show historically the last page on there how much we generate. Our best year was 2005. We generated just under $62 billion in taxable transactions and generated about $3.5 billion both in sales tax and vehicle license fee. Now, unfortunately, we are a pretty good example of what's happened to the economy because these are larger durables. Since 2008, we've lost 315 dealership closures. That's about 20,000 jobs just from there, and we've laid off another 20,000 people in the remaining dealerships. So we've gone down from about 1,600 dealerships down to just under 1,300 dealerships. As you'll see, the first chart that I have in here, I just looked at historical sales, so you can get a perspective on that. And as you'll see here, last year we only sold 1,038,000 vehicles. That was our worst year since 1975. When we had 17 million fewer Californians, and we had only sold 956,000. Compared that to the 2.1 million new vehicles that we had sold in 2005. 6 out of 9 years, we had sold over 2 million vehicles. So, of course, that will show you one of the reasons that your sales tax revenue is drying up from your largest generator. And, of course, if you're worried about your house payment foreclosures, whether you have a job or not, you're not going out and buying a new car. So we can certainly understand that. One of the things I thought would be productive is to take a look at the second page here. And I just wanted to kind of give you a real, sort of kitchen budget look at how this would affect the largest durable that most people buy. Most people don't own homes in California. Just about everybody owns a car. And the average price of a new car last year was $27,958. So I took $28,000 just to sort of as a rough number to take a look at that. And you can see, and I only had the sales tax, and I took Los Angeles, that's our most populous city. sales tax last year, before they did the local increase, was 8.75%. That was before the budget deal. And you can see there they would pay on a $28,000 car about $2,450 and VLF of $182. Of course, that was increased as part of the budget process. The 1% increase and the doubling of the VLF resulted in a 1-year period an increase to the consumer of just under $500. If you take the $420 more in tax that was paid, and then also you pay, most people can't afford to pay the VLF and the sales tax when they buy a car, so they finance it. So I assumed a 6.5% interest over a 4-year period, and that adds another about $60. So it's a $480 increase. That's a substantial increase. I mean, that's a couple of car payments right there, and in some instances a down payment. Again, a barrier to buying that vehicle. If you take a look at the proposal here to reduce the sales tax by 1.75%, even with a 0.5% VLF increase, that's still a net reduction. And if that was adopted, we would see a reduction from today's price of about $400 a car. I mean, these are real numbers that will stimulate vehicle purchases. And if we put in the extra 0.75%, which is included in the proposal next year, that would lower a price of car from today, assuming they remain at about $28,000, by over $600, $638 if you include the interest component in it. Which, of course, then gets you into the whole concept of, and I'm not an economist, but I've been doing this for a while, of the elasticity of price demand. And, you know, it's simply the proportionate change in demand given a change in price. And the rule of the thumb basically is for every 1% decrease in the price, if it increased by 1%, the elasticity of price demand would be 1. And in the car business, in the long term, historically, price elasticity has been 1. In the short term, though, when you make changes such as this, it typically is in the 1 to 1.5% range. So I figured with these changes, especially staggered so that they would continue to generate interest in it, the price elasticity, I think, realistically would be about 1.25. Which, based on our lowest sales year, or this year, we're projecting to sell about 1.2 million, about 170,000 more than we did last year. That's 15,000 more cars a year, and if you put in the second component, the 0.75, that would be 30 or 40,000 more cars a year, which in and of itself, even under the reduced rates, would generate an additional $80 million, according to our calculations, in sales tax. Now, that'd be offset, obviously, by the reduction. So the two big things, other sort of policy issues that I'd like to talk about, at least as it comes with new cars, are that as I mentioned before, we've seen about 40,000 of our employees laid off in the last year, either through closures or reductions, because if they're not buying cars, we don't need them. We don't need lot boys. We don't need to wash the cars. We don't need F&I managers. We don't need sales managers. We're even laying off some mechanics because people aren't being able to come in. So it would be a huge job generator, and dealerships typically offer higher paying jobs than other retailers because you need to have a lot of other skills with respect to it. So we really believe it'll be a job creator. And then the other policy issue that I would like you to keep in mind, as long as I have the microphone for a minute, are, quite frankly, issues that we're going to have to face as a result of greenhouse gas and CAFE requirements. Our current fleet average requirements are at 27.3 miles a gallon. By federal law, they're going to go to 35.5 miles per gallon in model year 2016. That's really only 5 model years away from now. And in order to achieve that, we're going to have to collectively do down-weighting, downsizing, and quite frankly, we're going to have to hang some pretty expensive technology on those vehicles. Hybridization, electrification, I think it's a little early yet for hydrogen, but we're looking at all sorts of those. And of course, there's infrastructure costs and whatnot. So I can tell you one thing, though. The price of these vehicles are going to start to go up as we implement that. So finding a way to offset that by sales tax, the out-the-door price that the customer always wants, what's my car payment going to be, what's the out the door, I believe makes good public policy as well to stimulate the sale of these vehicles. I mean, the policy decision has been made to reduce greenhouse gases, but we have to find a way to sell these vehicles. And, you know, one of the earlier speakers talked about gas tax increases. I know they're politically unpopular, but we know that the sale of little cars really spiked 2 years ago or a year and a half ago when gas prices went up to $4. So I don't think we can divorce ourselves from the policy issues when we look at these, but from the state's largest retailers, we think this plan makes a lot of sense. Thank you.
Other questions of either one? All right. Thank you very much. We now have time for public comment. Western Center for Law and Poverty is first. So please come forward. I'd like to see hands of all those who wish to testify on this issue. Oh, well, come on down. I only see one hand. Jean, come forward. Is there anyone here from the Western Center?
I'm here.
Oh, well, good. Come on. Then we have two. We'll let him go first, and then you're second. Okay, we have another chair, and then we're going to go into our hearing on bills. We have 4 bills in front of us. Welcome.
Thank you, Senator. Mike Carroll with the Western Center on Law and Poverty. And I should say at the outset today, this has been mostly a learning experience for me. I mean, I'm a welfare advocate, but obviously we have a huge stake in the outcome of this decision. As you know, over the last 3 years, more Californians than ever have become dependent and have needed our safety net. We've added 100,000 CalWorks families, 1 million people to the food stamp rolls, 1.3 million people to Medi-Cal. In a recession like this is what we have a safety net for. But we're facing a governor's budget that seems to think we have a safety net that needs fixing, and it would make drastic, permanent changes to our safety net that would affect literally hundreds of thousands of Californians. And so from that perspective, we are very supportive of revenue proposals that will alleviate and reduce the amount of cuts that will have to be made in this budget. And again, we're not experts in the tax field. I can see at the table we have folks who are going to be, I think, more able to address those issues from a low-income perspective. However, we think the degree to which we have a package that can begin to stave off the worst of these economic cuts in the short term, retain the federal funding that some of the other witnesses talked about. In the case of CalWorks, the governor's proposal would eliminate $3.7 billion in federal funds that come here every year on an annual basis, and mean we would not get federal stimulus funds from the ARA grants that last year we got in the range of $300 to $400 million additionally on top of that. All of that economic impact will be lost from the state of California. But there's also a human impact to all of this. These kind of proposals have extraordinarily harm for people. 1 million children in the state of California count on the CalWorks program to provide basic sustenance. It seems to us that the tax proposal is a serious effort to try to eliminate this kind of harm on families. And we would encourage the committee to consider it strongly. Now, we also look at the proposal, and we have to admit we were a little bit discouraged in that we did not see an increase in, the ask from the upper tax bracket folks where we think there's more money. We think that this ought to be considered seriously as you go forward in your deliberations and think about ways that perhaps that could be used to ameliorate the potential impacts on working class families who are not getting wealthy, but who apparently would have some slight increase in their taxes if you, according to what I heard earlier, and wasn't always sure what I heard earlier, but it seemed like there might be some impact on those families. So we would encourage you to think about that kind of a shift to make it more balanced. But in general, we support this approach, and we would underscore what it does for the budget and what it does for the economy as we move forward in California. Thank you for your time.
Thank you for your comments. Ms. Ross, welcome.
Jean Ross, Executive Director of the California Budget Project. Thank you for the opportunity to speak to you, and I'll try not to repeat anything that's been said earlier. And I would associate myself with all of the comments regarding the relative impact of spending cuts and tax increases on the economy. We believe that a balanced approach is imperative. I would give the plan high marks for being balanced in that respect and bringing some hard cash to the budget in an ongoing way. However, I think it's a poorly targeted plan in that it hits the middle of the income distribution particularly hard, would actually, depending on how you assume that the sales tax paid on businesses passes through to households, would either give virtually no increase to the highest income Californians or an actual tax cut at the high end. We asked our colleagues at the Institute on Taxation and Economic Policy in Washington, D.C., and they have the only comprehensive model in the country that's able to look at the distributional impact of changes in state and local taxes to analyze this tax plan. And what they found is actually similar to the LAO's findings in that you would have a fairly significant tax increase among and again, depending on what you assume regarding the share of taxes, the sales tax cut that would go to businesses, either sort of lower middle to higher middle income taxpayers or sort of middle to higher upper middle income taxpayers would have a fairly large tax increase. The highest income Californians would have a tax reduction. And actually, the plan looks fairly good, better than I think we initially anticipated for the poorest fifth of Californians, and that is because of the size of this reduction in the sales tax rate. Senator Steinberg appropriately asked people who were critics of the plan to offer a suggestion for how it could be done better, and I'd offer two suggestions. First, within the income tax side of the plan, that you increase the 9.3% rate by that 1% rate, and you use the revenues from that increase to buy out the increase at the lower end of the personal income tax brackets, the 1-2. You could probably even buy out the reduction in the 4% rate if you did that. Certainly the Franchise Tax Board would be able to advise you on what you would be able to do. And then on the sales tax side, I think the reduction in the rate is a good thing, but rather than use it to offset a reduction or to offset an increase in personal income taxes, I would look towards broadening the sales tax base to include some services. And I think that's important because the way the plan is currently structured, the state will become even more reliant on the personal income tax. And I think we would be putting too many of our eggs in one basket, and that there's a way to achieve some similar goals, but to maintain sort of a diverse basket of eggs in terms of where our revenues come from. And I think there are also some issues that we're very concerned about with respect to the plan as it's currently structured. Not only would it shift the cost of financing public services from the high end to the middle, it would also provide a very significant tax cut to business who would pay the lower sales tax rate and would shift that onto households. And I think by sort of looking at a change in the PIT structure, personal income tax structure, that's wholly contained on the one hand, and on the sales tax side on the other hand, you could also maintain better equity between households and businesses. And I'd like to close with respect to the targeting. And we have been very clear for the last several years since we entered this very significant downturn that we think that tax increases are better from an economic, from a job standpoint than spending reductions, but we've also been very clear that the best economic research, all of the Nobel Prize winning economists who have weighed in on this will tell you that you need to carefully target your tax increase. And what you want to do from a job standpoint, from an economic standpoint, is to target the high end, not the middle, and not the low end. And I think that is why I started out by saying that this is not a well-targeted proposal, is it really puts most of the increase on families who are struggling to make ends meet and who have had, as a chart in our paper shows, virtually no increase in their incomes after adjusting for inflation over the past 15 years. Thank you.
All right. Thoughtful as always. Thank you.
Lenny Goldberg, California Tax Reform Association. Much of what I've said has already been said, and in speaking with the leadership in the legislature, we fully understand that the trade-off between, as Mike Harold talked about, the cuts in the poor and the wiping out of very critical programs versus tax increases is something that we've had to live with for quite some time. And for example, we thought the February tax increase, the significant tax increase of a year ago, February, was really poorly targeted. It was heavily fell on middle class and including sales tax on working and lower income people. At the same time, that's obviously going to be better than some of the severe cuts that we had to schools and services. So that said, there's always this balancing that the legislature has to go through. The improvement, I think when you look at incomes, if you look at the percentage of income of the top 1% in California, which has gone in Department of Finance numbers from 13% to 25% of the income in California, that's an incredible number. The 1% having 25% of the income. That's unprecedented since 1929 in this country. And it really is an extraordinary amount. So when you're looking at taxing, the improvement we would make in this to take that mandate would be to really continue to look at the upper brackets. Many of those consumption items or savings are really not about reinvestment in the state of California. I know you hear that, this affects small business. As a small business, I pay through the personal income tax, but that really is after the fact. That's after you've earned the income. That's after you've earned it in California. And that can relieve some of the burden that may be in here on the middle class or lower, or it can really be part of a general package that really does improve the package. Again, not to criticize because of the extraordinary constraints that the two-thirds vote provides and the need to balance it off. And I'll refer back to Senator Wright's comments, who said, okay, everybody in, but in this package, everybody is not in, and the very wealthiest are not in. And so we strongly urge you to make that addition to this.
Thank you. Welcome.
Madam Chair and members, Vanessa Kahina on behalf of the California Immigrant Policy Center. We'd like to associate ourselves closely with the comments of my colleagues, particularly with Mr. Harold of Western Center on Law and Poverty. We are generally highly supportive of this approach. However, we would like to see that the upper income tax brackets get added back into this, perhaps in the discussion as we move forward. It really would save California from the worst of the worst cuts, many of which have already taken place. So we thank you for your attention to this and hope to work with you in the future.
Thank you for coming. Any further comments on these issues? All right. Are you coming? Oh, all right. I want to thank you all for coming. First of all, Professors Bankman and Stark, thank you. Bill Dombrowski and Peter Welch, and of course from the Legislative Analyst's Office, Jason Cisney and Jay Chamberlain and Robert Ingenito, who are here normally. But thank you from the FTB and the BOE. We're now going to move on to our business for the day. We have 4 bills. I would like to invite, how are we doing? Do I need to take a break? Are we okay? Okay. All right. First, Assemblymember Portantino, AB 1178. You want to come forward? All right, welcome, Assemblymember Portantino. Thank you for waiting. Appreciate that.
Thank you, Madam Chair.
Bill is yours.
President Obama's health care reform legislation enacted March 23, 2010, and subsequently amended on March 30th, made changes to federal income tax law. Since California does not automatically adopt such provisions, we need to enact state legislation to incorporate federal changes into our state tax laws. AB 1178 is that legislation, incorporating 15 conformity items from the two recently enacted federal health care acts. In addition, it conforms California law to the federal treatment of health savings accounts beginning in 2013. I understand there's going to be some amendments on that particular provision. Many tax provisions in the federal health care already took effect in 2010. By conforming California law to those federal provisions, AB 1178 would ease the burden of tax compliance for both taxpayers and practitioners. Among other things, this bill allows a taxpayer to exclude from his or her gross income the value of health coverage provided by the taxpayer's employer to a taxpayer child under the age of 27, and various other conformity measures. I have with me representatives of FTB who can add some information, and certainly want to hear from the chair.
All right. Welcome.
Thank you. Good afternoon. Brian Putler, Franchise Tax Board. Usually I only get to say this once a year, but because we're having two conformity bills this year, I get to say this again. And that is that conformity bills offer what is probably the greatest bill toward tax simplification that members get to vote on each year. Therefore, the FTB staff and the three-member Franchise Tax Board have a long-standing position in favor of federal conformity. And I'm joined here today by my colleague Scott McFarland in case the members have any technical questions about the bill.
All right. Further comments? Witnesses in support? Witnesses in opposition? Come on. I'll have to ask you to
give up your spots.
Welcome.
Thank you. Good afternoon. Michelle Peelsticker, California Taxpayers Association. While we are generally supportive of the idea of omnibus conformity, our major concern with this bill is that it's a gut and amend at the end of session. And because of the major policy implications in a large conformity bill and the extensive analysis required in terms of cross-referencing federal law to state law and understanding the various provisions of the bill, we would like to see this kind of a bill come forward with an interested party stakeholders meeting in the interim, and then have a discussion and do the bill in January. We don't think the bill needs to be done at this time at the end of session when there are competing priorities, but would like to engage with the author in the interim.
All right. In opposition.
Thank you. Mary Gerton here on behalf of the California Chamber of Commerce. I would just like to echo the statements of Ms. Peelsticker and just say we would very much like to work with the author on coming to agreement on something like this. We just don't have the time to get into the level of analysis to know yet whether the provisions as they are written would be beneficial to everyone. So thank you.
Okay.
Lenny Goldberg, California Tax Reform Association. We have testified numerous times at this committee in opposition to the extension of HSAs for many reasons, which Ms. Capel can also elaborate on, but basically high deductible policies really don't help those that really need health care. So we would urge that come out of the bill. We do strongly support, part of this bill, the economic substance conformity, which we have had many extensive hearings for many years on, and believe that's a really important addition.
Yes, Beth, you're next.
Beth Capel on behalf of Health Access California. We, as this committee knows, have always opposed the extension of conformity for health savings accounts. We do recognize that with the enactment of federal health reform that in 2014 we will be in a different place. However, we don't see a need to conform at this time. We have some more time to work through those issues, and we respect the intent of the author to try and move us forward on that, but it's a little quicker than we're able to handle this time of year. Thank you.
Okay. Madam Chair, members, Sarah Flox from the California Labor Federation. We also have a long history of opposing health savings accounts and conformity to them, and we would thank the author for considering to remove that from this bill. Thank you very much.
Jai Suprasad with the California School Employees Association. I'm also here on the health saving accounts and just in support of the staff recommendation that this piece be removed. Thank you.
All right, thank you. Further support or opposition? All right. This bill, because of our rules, will go to suspense, but we're going to remove it from suspense. But in doing that, this is an important bill that we do have to pass. We do need to approve this. Without the bill, federal health care reform can't be effectively implemented in California. If it's not enacted, taxpayers will have to include new benefits in their state income taxes next year, but not for the federal. Treating the benefits in any other way would contradict with longstanding income exclusions for employer-paid health care in state law. The author has agreed, however, to remove and take these amendments in appropriate. He will remove the HSA high deductible health plans. Come 2014, these issues will need to be addressed, but the fiscal issues still are critical and major. And we can work, we hope, to couple HSA conformity with the AGI thresholds that we're also going to have to delete today. So I would ask you if you're comfortable with that and if you'd like to close, and then we'll take action.
Yes, Madam Chair, I understand the genesis for the amendments, and I think you understood the genesis of why we put them in.
Correct.
And we'll have to deal with this issue at some point, and to continue to move the bill, we'll accept the amendments. You described well. I know FTB wanted to explain why this was necessary now, and I think you did a good job in covering the urgency matter. So we're happy.
We'll take that up at the end of the hearing. We'll remove it for suspense at that point. But just to ask Mr. Putler, is there anything you wanted to add to what I said about why we have to do this now? Any clarification?
No, I don't think there's any really need to clarify anything.
All right. Then at the end of the hearing, we will go to this suspense file and remove it with those amendments to be taken in appropriate. Thank you very much. You have another bill, which is number 3, AB 2788.
Thank you, Madam Chair and members. AB 2788. Currently, California exempts trailers and semi-trailers from sales and use tax for vehicles that are not intended for use in California and are in fact moved out of the state. AB 2788 would eliminate a differential as specified in current law and would instead institute a 75-day time frame. I know that our staff and your staff and the supporters of this measure have been going around with some amendments. It would be my hope to move the bill as is, with the understanding that if at the end of the day we don't have the chair's sign off on this, that we would not move it for a vote of the Senate floor. But I would respectfully ask that it move to allow all the folks who've been working on it today to have a couple days to see if there is a compromise that can be struck, but the full understanding that the final decision would be the chair's.
All right. I think that makes a great deal of sense. I think that we are close, and I think we'll get there. So in good faith, we'll work on that, make sure that happens. But let's present the bill as is.
Okay. Thank you, Carolyn Gill-Hunter, on behalf of Hyundai TransLead. It's been a long-standing practice in the state of California since 1959 that the sales of vehicles such as tractors, trailers, trailer coaches, trucks, truck tractors, etc., be exempted from sales tax when the vehicle is to be used exclusively outside the state of California. In 1970, that exemption was extended to include vehicles when they were going to be used exclusively in interstate travel. As noted in the analysis, AB 2788 would authorize extending that exemption to purchasers whether the item was purchased from a dealer located inside or outside of California. The bill would also increase the time frame from 30 to 75 days in which the purchaser must remove the item from the state and put it to use in exclusively out-of-state, interstate, or foreign commerce. Just as in 1982, when the time frame was initially increased from 30 to 75 days to allow trailers or semi-trailers to be moved to a point outside of California because of a concern about meeting the 30-day time frame, there's a similar concern today about our client's ability to move the product outside of the state in a 30-day time frame. The coordination of delivering, loading, and putting the vehicles into operation in 30-day time frame is problematic to potential purchasers and doesn't enhance California-based retail operators the ability to attract business because of that tight time frame and the potentiality of missing out on a tax exemption that they should have had. So modifying the time frame to 75 days would create a level playing field to all retailers of these vehicles. The Board of Equalization has reviewed the bill and concluded that any sales or use tax revenue loss would be minimal. So I would urge your aye vote, and I also have with me today Rex Halverson, who can talk to you about some of the existing penalties that exist for noncompliance with the existing sections already in place.
Okay. One of our concerns was the issue of enforcement, so go for it.
Hi, I'm Rex Halverson with Rex Halverson & Associates, and I was the former Deputy State Controller Tax. I've practiced state and local for 32 years. My comment about penalties that we've been discussing are the Board of Equalization already has a 10% negligence penalty, they have a 25% fraud penalty, and they have a 50% fraud penalty. So in my opinion, the penalties that we have on the books are more than adequate. And the other amendment being suggested was one for a affidavit after the fact to make sure you moved it out of state within 75 days. And my comment was there's already an affidavit in the file of the seller of the trailers and dollies that we're talking about, and therefore there's a clear paper trail for the BOE to follow. My client is audited every 3 years. The Board of Equalization auditor takes a look at those affidavits in person and reviews every one of them. So in my opinion, to have an affidavit after the fact wouldn't accomplish anything, and to send it to the Board of Equalization would create a paper filing mess. You could do it electronically, but it still creates the same thing that the board doesn't want. When I sat on the board, I clearly know that we don't have resale certificates sent to the Board of Equalization. Resale certificates are audited at the client level. There's no need to have a duplication. The auditor can clearly look at them at the source and make his determination as to whether they're valid. Thank you.
All right. In support of the bill, further support? Opposition? All right. Are there any questions from the committee?
This is for due pass.
This will be due pass. I'm still holding to the sunset, however, as we get into these discussions. I think that's important to recognize. And the issue is really one of enforcement here. That's what we were trying to get at. It is due pass with the agreement that this will work, and this won't come up on the floor unless we've come to an agreement. All right, so it's been due pass. Please call the roll.
Wolk.
Aye.
Wolk, aye. Alquist.
Aye.
Alquist, aye. Ashburn.
Aye.
Ashburn, aye. Padilla.
Aye.
Padilla, aye.
4-0. 4-0. That is out.
Thank you.
Thank you, Assemblymember. Assemblymember De Leon. You have AB 1511. This is a suspense candidate. A good bill. And a good bill. Welcome.
Thank you, Madam Chair. Good afternoon. I know it's been a long afternoon for each and every one of you.
Thank you for waiting.
I thank you, Madam Chair, as well as Senators, for the opportunity to present AB 1511. Just tell me when, and I'll go.
Go ahead.
Thank you. Madam Chair, thank you for the opportunity to present AB 1511. This bill seeks to generate desperately needed tax revenues and help alleviate our ongoing state budget crisis. Extending the temporary suspension of the net operating losses carry forwards, delaying the assignment of tax credits and stopping NOL carrybacks and the elective single sales factor from taking effect would save our general fund from losing approximately $1.8 billion in the current fiscal year. AB 1511 also contains permanent corporate tax reform, implementation of a mandatory single sales factor, and the repeal of NOL carrybacks as of January 1st, 2012. These last two pieces would generate hundreds of millions of dollars in revenue annually starting in next fiscal year. Let me underscore and highlight that this would be ongoing revenue coming into the general fund, which would be not a complete solution, but nonetheless, it will be a part solution with regards to the budget crisis and the deficit that we're dealing with today. Let me take a moment just to briefly highlight two of the last points that I just underscored. As you know, Madam Chair, as well as members, California corporate tax rate incorporates three major factors. We have payroll tax, we have our brick and mortar value of your property, as well as sales tax. And California's adoption of the single sales factor method of apportionment last year, instead of adopting a mandatory single sales factor like the vast majority of states in the union, that being Michigan, Illinois, Oregon, the state of New York, as well as just a few months ago in the month of April, the state of Washington, our tax law here in California on an annual basis is optional and elective single sales factor. If I can stand corrected, but I believe that the state of Missouri is the only state nationwide that offers an elective single sales factor. The Legislative Analyst's Office, the LAO, reports that getting rid of the option and adopting a mandatory single sales factor would result in a positive net gain of 40,000 jobs. And this is not hyperbole. It's not a misstatement. Let me underscore that this is very crystal clear, that the methodology is solid. The facts are clear. The LAO says during an unemployment rate of 12.2% with a mandatory single sales factor, we can actually increase employment by 40,000 jobs here in the state of California. A few things is that we need to put California first and get rid of this unfair competitive advantage. We need to encourage job creation and greater investment here in our home state instead of rewarding out-of-state corporations at the expense of California-based companies, but just as importantly, at the expense of California taxpayers. To be blunt, Madam Chair, as well as members, we're going to have a system with the expertise where folks are going to be able to game the system. And if you game the system here in the state of California, ultimately you are gaming the taxpayer. Now, one of the issues that I think is very critical to highlight is obviously the issue of the NOL carrybacks. Corporations will be able to write off their losses for the very first time in our state's history, their income in the prior last 2 years. This means that corporations can go back in time, the last 2 years, and look at what they got in terms of losses and offset that. And when you start doing that, you start amending your tax documents and going back in time, obviously that's going to interject a tremendous amount, a substantial amount of volatility to our state budget as if things are not bad enough today. Now, this is going to cost us millions of dollars. What we need to do is we need to create jobs in California. These are corporate tax rates that we simply cannot afford to give at this time. Simply put, to conclude my statement, Madam Chair, this bill delays, it eliminates, and it alters the most controversial aspects in the history of California corporate tax law. These mandatory, or I should say the elective single sales factor, as well as the NOL carrybacks. Madam Chair, Senator Wolk, as well as members, I do understand that this is a bill that is a candidate for suspense file. I do respectfully ask for an aye vote when it is up for your consideration. Thank you, Madam Chair, as well as members. I just want to highlight a couple individuals I hear with us today is Justin Garosi, who is the author of the LAO report with regards to the elective, or I should say the mandatory single sales factor. He is a PhD at the University in economics at the University of Michigan, but I'm always here to answer any technical questions also too on this issue. I'm very clear about that. Also, we have to my left, literally and figuratively, is Mr. Lenny Goldberg from the California Tax Reform Association.
It's on my right.
It's on your right.
It's on my right.
On your right.
Not always.
Yeah, also here. So thank you, Madam Chair, for the opportunity.
Okay. Welcome, sir. Just push the button. Well, take Kevin's.
Yeah, we got it.
It's a budget problem.
Senator Wolk, do you have any, or any of the other members of the panel, do you have any specific questions?
Why don't you just present?
Okay.
If we do, we'll ask.
Yeah, in our report that we put out when was it, a couple months ago, we recommended that the state retain the single sales factor but make it mandatory. And the main, sort of the basic idea behind that is that using a single sales factor can prevent California firms from being put at a competitive disadvantage because of the way that state apportionment formulas work. It's possible if we had retained our old double-weighted sales factor, if a firm produces in California but sells into a state that uses a single sales factor, it's actually possible for this for that firm's taxable profits as summed up by individual state to exceed its nationwide taxable profits. And so that could put the California-based firm at a competitive disadvantage. If every state in the union went with the double-weighted sales factor, there wouldn't be a competitive disadvantage from doing that. But given that the bulk of the big states in particular are now on the mandatory single sales factor, we kind of have to adopt it in order to sort of keep up and prevent our firms from being placed at that kind of a disadvantage. Now, we recommended making it mandatory as opposed to optional for a couple of reasons. One being that when you make it optional, you give firms an incentive to change the apportionment formula they use, whether they're making money or basically to use one formula when they're making money and the other when they're losing money. And so this has kind of the strange effect of giving the biggest benefits to firms that are, entirely located in California or mostly located outside of California. So basically the bigger, the disparity between your California share of sales and your California share of property and payroll, the more you benefit from that. The more balanced you are, say, for example, you have 15% of your property, 15% of your sales, 15% of your payroll in California, you don't benefit from that at all. And so that creates some kind of strange incentives, in particular with regards to firms that have a very small percentage of their property and payroll in the state, but a large percent of their sales. Also, I guess, the general issue with any policy we talk about is sort of what benefit do we get and what does it cost the general fund. As the Franchise Tax Board has come up with new estimates of, what it would cost the general fund to institute optional single sales, and you can see the cost is fairly high. It tends to run a little less than $1 billion a year. And yeah, there would be some firm or in some ways the state would benefit from having optional single sales. I mean, basically it would help in particular firms that sell into the state but don't have a lot of facilities here, and so that more or less would maybe slightly reduce the cost of living in the state, if you sort of think about it that way. On the other hand, you can do a lot of things with roughly $1 billion a year. And so with pretty much all policies, we try to say, okay, well, is this an effective use of that money relative to the alternative uses?
Thank you very much.
Yes, Lenny Goldberg, California Tax Reform Association. I'll start by saying, let me start with lost carrybacks, and fully support Assemblyman DeLeon on this. If we had lost carrybacks as a policy in the state of California prior to in the last 5 years, we would have been sending in 2008, as the recession was hitting heavily and the financial crisis was hitting, we would be writing refund checks to Countrywide and Wachovia for the profits they made on putting us into a financial crisis. And that one part of it is there is no incentive effect to making profits one year and then later you're taking your losses. Now, maybe we talk about loss carry-forwards as saying we've made new investments that don't pay off right away, so we carry forward those losses till they pay off. Carrying back those losses has really no economic impact in terms of any new investment. And the second piece of that is it is terribly destabilizing to the budget. We have collected the money, we have spent the money, we've booked it, we've put it in our budget, and then 2 years later, particularly in a time when the economy may go down and we're taking losses, we have to write refund checks to companies who paid their taxes 2 years ago. So that we really should not. In many hearings, we never even considered these in hearings. There were bills in front of this committee that had both loss carry forwards and loss carry backs, and before the hearings occurred, and I remember this explicitly, the loss carry backs were taken out because they were unjustifiable. Now, with regard to mandatory single sales, we've never been a fan of single sales. We understand the argument that other states are doing it and it becomes very difficult. We don't think there's evidence that it benefits, and there are a lot of possibilities for manipulation. I think this legislature, in some of the other provisions that went with single sales, particularly with regard to the apportion of royalties and intangibles, did help avoid some of the manipulation that takes place, tax manipulation that takes place with regard to single sales. The worst thing we could have done, however, was elective single sales. And that, as Mr. Garossi said, allows you, when you're taking a loss, to choose one, when you're taking a gain, to choose another. But beyond that, if there is ostensible incentive impact to using single sales factor, and we argue with that, but if there is, we've truncated it, cut it in half by giving no incentives for outside companies that sell heavily into California to move into California. The other thing is that, and the last thing, and I'll finish with this, we have always been very in agreement on many issues with the Franchise Tax Board, but we are terribly disappointed that they projected at the time this decision was made on elective single sales that the difference between mandatory and elective was on the order of $200 million. Yeah. It is nearly $1 billion a year. I stipulate and that this legislature never would have accepted a difference when they were doing those negotiations that was $850 million to $1 billion a year. I was very surprised at the small amount that was, because when you go to mandatory single sales, your outside companies that are selling into the state are going to have to pay more unless they locate in California and they're relatively equivalent, but and the companies in the state pay less. And when we didn't do that, the number was extremely low. I was very surprised at that number, and it turns out it was flat out wrong. So that is one just obvious reason. This legislature acted on the basis of not just imperfect, but information that turned out to be wrong. Way underestimated cost of that effort, and I'm not surprised to see that based on what I know about how these things operate. But I was I'm glad the FTB has now gotten it right, but now the legislature has to get it right.
Or your people.
Vanessa Hina on behalf of the California Immigrant Policy Center, here in support, just to say that implementing these tax policy changes are going to create a problem next year, the year after that, and put us in another problem and give us more hits that our general fund can't afford to take.
Okay. In support of the bill, come forward. Very briefly.
Rebecca Gonzalez, National Association of Social Workers, California chapter. We think this bill makes a lot of sense. It makes needed improvements to our tax system, and it has the added benefit of bringing more revenue into the state when we desperately need it. So we ask for your support.
Thank you.
Jai Sukprasad with the California School Employees Association, also in support.
All right. In opposition, please come forward. We had two speakers in support. I want to choose two in opposition that I'll give more time to, and then the rest will be very brief. So you want to choose amongst yourselves?
I don't know who all these people are. They may not want me to speak. Estella Mew with the California Teachers Association. Okay. And we oppose this measure because, first, while the analysis may say that it generates revenues, we don't think so, and let me tell you why. This bill has not been implemented, so it would take away revenues from the general fund if it was implemented. If there was no bill, revenues would remain where they would be. And so for us, when we say we're looking to raise revenues because schools have taken, as you well know, a $17 billion hit and are going to be facing a few more $1 billion this year of hits. And to mitigate what we've done to our schools, we need to increase revenues. So for us, this is not an increase. The measure for sure goes a long ways in improving what the deal was last February. But more importantly for the California Teachers Association, we are the sponsors of Proposition 24. And that particular initiative would take care of all the loopholes that were created last February. And we believe that what the analysis says, let's perhaps wait to see what the voters say once November is the election comes, and if they speak loudly and clear and go along with CTA's measure, then there won't be a need for this bill. If not, then we can come back and revisit this measure next year. Thank you.
Thank you.
Thank you, Madam Chair, members. Mira Girton here on behalf of the California Chamber of Commerce, also in opposition, although for different reasons. All four of the different components of this bill were part of an economic stimulus package that, as Ms. Mueller, Mr. Name, but as CTA mentioned, that were part of the package last year to help offset over $12 billion in tax increases that were supported by industry. We believe, on behalf of the industry, that it's important to have stimulus components as well as cuts and things that you need to do in order to raise revenue, because you need ultimately to grow the pot, and we can only do that with these measures. We believe that there's real value to these provisions as they are currently written. They are not just out to benefit out-of-state companies. They are not just about letting people pull money out of the pocket of the state. They help keep businesses keep their doors open and to keep people in their jobs so they do not need to further rely on the state for more support. We believe that this measure would delay our economic recovery, act as a tax increase on businesses, and also undermine the good faith that will be critical in the coming weeks as we negotiate a new budget, because we would be undermining something that everyone agreed to last year. Thank you.
In opposition, very briefly, because
very briefly, California Aerospace Technology Association. Just a quick note: lots been described about undoing prior budget deals. This adds an additional item, which is also suspends another 2 years the NOL carry forward to distinguish from the carry back. After the 08 and 09 tax years, that took effect earlier this year, so this would be another retroactive suspension. So that'd be 4 years for the carry forward, and the credit sharing has also taken effect, as opposed to the other provisions which take effect 2011.
Thank you. Now I just want ID very briefly.
Greg Hines, California Manufacturers and Technology Association, also opposed.
Opposition. Thank you.
Michelle Peelsticker, California Taxpayers Association, also in opposition.
Okay.
Joe Gregorich with Tech America in opposition.
Thank you.
Terry Thomas with the Motion Picture Association of America in opposition, and I would just like to say that we are particularly focused on two provisions in the bill: the delay of the single sales factor apportionment and the NOL.
Okay, thank you.
Bernie Orozco on behalf of the California Telecommunications and Cable Association. We are opposed because, opposed unless amended, we would like to see the cost performance restored. When this item was originally adopted in the February 2009 budget, we did not see the bill in print until after it had passed the Assembly, and then realized that there had been additional changes that were made. We're not opposed to single sales factor in and of itself. We just are opposed if it's a mandatory single sales factor without the cost performance restoration. Thank you.
Okay, thank you. Further opposition? All right, questions from the committee?
Just a
comment. Or comments?
Madam Chair.
Senator?
The items in this bill are those items that were included in the budget package, which included substantial tax increases and these relatively small stimulus items with the purpose of job creation. This was not an easy agreement to reach. It was a very difficult vote for members to make. And so, having the tax increases went into effect. The stimulus items and the tax benefits for job creation are now being proposed to be yanked off the table. I don't think that's the way that agreement should be kept. And it comes, in my mind, at the worst possible time, when California's economy is struggling even further, where we need every opportunity for the private sector, for the business community, to have some confidence that California is going to keep faith with the agreements that are reached, so that investment can take place and jobs can be created. That's the way that additional tax revenues are going to be generated to balance budgets, not the other way around. And so, in many ways, I view this as a bad faith measure, and with great respect for the author, I really do not like this measure and urge that we turn it down.
Okay, this will be going to suspense. Would you like to close?
Okay, thank you, Madam Chair. Senator Ashburn, I have a lot of respect for you as a person, and I know that you're a very principled individual, and you feel very strong with regards to your position vis-a-vis my measure, AB 1511. I know it's a candidate for suspense. I do ask Madam Chair, as well as members, when the opportunity avails itself, if you would give it every consideration. I do believe that this is very difficult economic times, no doubt, and I think that Democrats as well as Republicans alike must come together to do everything possible to create jobs. With regards to the characterization of a massive tax increase, I guess it all depends on how it's framed. To me, it does the contrary. It lowers your tax liability. For example, in my opinion, for in-state companies here in California, it incentivizes them to actually expand their payroll and operations here in California. Not in Oregon, not in Nevada, not in Arizona, or elsewhere. The delays in the measure, it's that simple, given the conundrum that we find ourselves in with regards to how do we find revenue, if we can find any revenue, that political chess game that we're all mired in at the current moment, and how do we make cuts that are as least painful to the most vulnerable in California. That's a conundrum we all find ourselves in, without a doubt, on both sides of the aisle. And this is a very difficult period to give corporate tax breaks that, in my opinion, won't provide the necessary incentives for job creation here in the state of California, coming from the private sector, which I agree. I do believe it has a perverse way of folks gaming the system to have a little presence here in the state of California. We need individuals, companies that are going to invest in California, invest in facilities, invest in terms of expanding operations. It doesn't mean that a CEO lives in California, in San Francisco or elsewhere, or down in Los Angeles, or perhaps their headquarters are here, but their facilities are elsewhere, where you have the majority of your job creation and expansion. Jobs must be created here. I think it's a proactive measure with regards to moving forward for job creation and just making the necessary corrections and modifications to delay, to alter, and in some cases, in AB 1511, to eliminate altogether for a fair corporate tax law in California. Madam Chair, I thank you for the opportunity to present AB 1511, and I thank you for your consideration.
Thank you. Thank you, Assemblymember De Leon. With that, AB 1511 will move to the suspense file. Thank you.
Thank you. Have a good day.
Is Assemblymember Ma here? If not, we'll take up the suspense calendar. I need a motion on AB 1178. That's the conformity bill. The motion would be to remove it from suspense and do pass to appropriations. It's been moved. Please call the roll.
Wolk.
Aye.
Wolk, aye. Alquist.
Aye.
Alquist, aye. Ashburn.
No.
Ashburn, no. Padilla.
Aye.
Padilla, aye. You have 3-1.
3-1. That bill is out. Welcome, Welcome, Assemblymember Ma. I'm looking for the number. It is AB 759.
Thank you, Madam Chair, members. I would like to begin by accepting the amendment in comment E of the analysis.
Okay.
AB 759 clarifies the type of businesses able to contract with the state of California. The language in the bill right now reflects a year of work between the supporters of the bill and both the Assembly and Senate policy committees. The original law, SB 640, was intended to prevent corporations that left the United States for tax haven countries from receiving state contracts. However, the law did not account for an increasingly global economy by failing to differentiate between legitimate businesses, mergers, and inversions. AB 759 establishes a set of criteria to determine which corporations are subject to the contract prohibitions. The criteria standard assures that California maintains a strong policy against companies leaving the United States for what is purely tax gain, while assuring that multinational companies that do leave the United States through a legitimate merger to a country that is a treaty partner are not unfairly disadvantaged. During difficult budget times, AB 759 will increase the amount and competitiveness of state contract bids and has the potential to be a cost savings measure. With me today to testify in support is Kathy Bennett with Tyco International.
All right, welcome.
Madam Chair, members, quick preemption. John Latimer on behalf of Tyco Healthcare and Tyco Healthcare and Covidian. I just want to quickly start by thanking the staff of this committee, both those here on the dais and on maternity leave, for working with us for more than a year and trying to figure this out. The overall benefit of this legislation is, again, a fair recognition of the distinction between an inversion versus a public-to-public cross-border merger between two companies, and that is a significant distinction. So we appreciate the time that it takes to get through and understand that distinction and issue by the staff. And with that, I would turn it over to Kathy Bennett from Tyco International.
Welcome.
Good afternoon. My name is Kathy Bennett. I am Vice President of Public Affairs for Tyco International, and I appreciate the opportunity to present Tyco's history and the reasons why we support AB 759. Tyco International is a conglomerate manufacturer and service provider. Its principal lines of business are security, fire, and industrial valves. Tyco International has more than 3,000 employees in California, operating at about approximately 30 facilities. Our largest California employer is ADT, which provides commercial and residential security. Our sister companies, Tyco Electronics and Covidian, also have some 3,000 employees in the state. While these companies were part of the same merger that created Tyco International in 1997, they are today separate, publicly traded companies. In 2003, California passed legislation which instituted a ban on state contracting with inverted companies. Unfortunately, that ban has also ensnared cross-border mergers, which are common in today's global environment. Tyco was created by such a cross-border merger and not a corporate inversion transaction. The hallmark of a corporate inversion is that it's sort of a self-help transaction. It occurs only between the company and its existing shareholders. In a typical inversion, a U.S. company creates a foreign subsidiary, usually in a tax haven, and through a complex transaction with the company's existing shareholders, causes that subsidiary to become the foreign parent. The exchange inverts the original chain of ownership, which is where the term inversion is derived. An inversion transaction stands in sharp contrast to a cross-border merger in which two independent companies with independent board of directors and unrelated shareholders negotiate the advantages, terms, and conditions of combining the companies for future international operations. After a merger, the new company emerges from the combined worldwide operations of the independent companies. There is substantial and permanent economic change in the combined operations and shareholders. In a cross-border merger of publicly traded company, there's no opportunity to collude or in a self-help fashion to manipulate U.S. tax avoidance. And this isn't due to the independent and often adverse interests of unrelated parties when they negotiate a merger and the required approval of hundreds, if not thousands, of shareholders. Today's Tyco was established 13 years ago in the cross-border merger transaction. Tyco is the combination of former Tyco International and ADT. ADT was a Bermuda-based company for 13 years before the merger. The merger made good business sense because Tyco International and ADT had complementary businesses. Tyco's was the world's largest fire protection company, and ADT was the largest electronics security company in North America and the UK. Well, I'd be happy to share the more technical details of the transaction should the committee wish. The merger is really no different between Tyco and ADT, really no different than a Daimler Chrysler, a Deutsche Bank Bankers Trust, Vodafone AirTouch. I mean, they're very commonplace in the current global environment. Because we do not think the California contract ban was intended to reach cross-border mergers like ours, we have been working with Assemblywoman Ma and the committee's consultants on ways to address the problem. The result is AB 759, and we believe is a carefully constructed clarification of the contract ban statute. We respectfully urge the committee to support this legislation and help ensure its enactment this year. As you know, it will have no impact on Tyco's tax liability or any other company that is impacted. All it will do will permit us to bid for contracts in the state of California and hopefully make that process a more competitive one in the areas in which we play. We appreciate your consideration, and I'd be happy to answer any questions that you might have.
Thank you. Further support in the audience? Further, any opposition? All right. Any questions from the committee? All right. The motion is do pass as amended. Is there a motion?
Motion.
It's been moved. Please call the roll.
Volk.
Aye.
Volk, aye. Alquist.
Aye.
Alquist, aye. Ashburn.
Aye.
Ashburn, aye. Padilla.
Aye.
Padilla, aye.
4-0, and the bill is out. I know.
Thank you, members.
That should be our last hearing of the year, but who knows around here? But it gives me an opportunity. Opportunity first to thank my colleagues for their patience and their work, but also to thank Gail Miller, who's not here, lucky her, and Colin Grinnell, who has taken over while Gail has not been here, Marissa, our wonderful committee secretary, and Meg Swoboda and Mary Beth Faulkner, who stepped in when Gail decided to have a baby and did a wonderful job. And we really appreciate all the energy and effort and time that you put into revenue and taxation. Thank you. And thank everybody else. We are adjourned.